with the goal of with the goal to promote better understanding on Philippine taxation, the lecture series proposes to discuss topics on CREATE Act and preferential taxation. So, to our esteemed speaker, faculty from different schools, colleges, and universities, and most especially to all the current and aspiring tax partners who are currently here in the Zoom, it is truly an honor and privilege to welcome all of you to the University of the Philippines Visayas Junior Philippine Institute of Accountants first installment of the UPV Tax Lecture Series. So as early as now, allow me to acknowledge our official partner organizations for today's event, as all of this will not be possible without them. For the first installment of the UPV Tax Lecture Series, the University of the Philippines Visayas Junior Philippine Institute of Accountants is in partnership with UPV College of Management Student Council, UPV Junior Executive Society, UPV magnates, and UPV tycoons. And before we officially start the formality of the program, to loosen everyone up, to set the mood, and engage all the attendees here in the Zoom, we will have a very, very quick icebreaker to be facilitated by UPV JPS first year Consul General, Ms. Feby May G. Magabilin. So for now, I will turn the spotlight to Feby for the icebreaker. Feby?
Yes, so Nang. All right, now we will be having our icebreaker before we proceed with our program. So this game is all about logic. You will be raising your hands and I'll be asking you to unmute your mic to say the answer. So handa na ba kayo, guys? So if handa na kayo, then let's start. So for the first icebreaker, if 1 equal 3, 2 equal 2, 2 equal 3, 3 equal 5, 4 equal 4, 5 equal 4, then 6 equal what? So just raise your hands, guys. So we have Gia Bea. So yes, Nang, can you unmute your mic?
Hello. Good morning, everyone. 3?
So then 6 equal 3. So let's find out if 3 is the answer. Yeah, so 3. So thank you, Nang. Next, let's proceed to the next. I am an odd number. Take away one letter and I become even. What number am I? So we have Angela Eroy. Can you please unmute your mic and introduce your name?
Good morning. My name is Angela. I'm actually a BS management student. The answer is 7.
7. So let's find out if 7 is really the answer. So yeah, 7 is the answer. That's correct, Angela. We will be taking note of that. Next. What is the number of the parking space covered by the car? Okay, we have Ian Kenneth Lim.
Hello, good morning.
Hi, good morning. Can you please introduce your name po? And
hello, I'm Ian Kenneth Lim from Philomar Christian University, JP.
Okay. So, what is your answer po?
87.
87. So, let's find out if the answer is 87. So yes, the answer is 87 because if you flip the image upside down, you'll see that what you're dealing with is a simple number sequence. So that would be all. Sana nag-enjoy kayo kahit panandali ang saya lang, guys. Char. So we will be taking note of the winners and we will be contacting you. So right now, Nang Dea, you may take the floor.
Ayan, so syempre maraming salamat para sa talagang nakakagising na laro, Feby. At sana nga ay tuluyan ng na-break ang ice. ang awkwardness, ang hiya ng karamihan na nandito sa Zoom para mamaya sa talk, maging active at responsive na ang lahat sa ating inimbitahang tagapagsalita para sa araw na ito. Paalala lamang sa lahat na hanggat sa maaari ay panatilihing nakamute ang inyong mga microphones sa Zoom for now dahil mamaya mayroon naman kayong pagkakataon na magtanong mismo sa ating guest speaker. Pero habang nakamute kayo sa ngayon, pwede kayong magbukas ng inyong mga camera kung kaya ng internet connection upang magkakitaan naman tayo kahit through Zoom lang. So, ma-flex ang mga Zoom background at para damang-dama ng ating guest speaker mamaya ang presensya ng bawat isa. Basta daw mga interesado matuto, active yan. Kaya patunayan natin ang ganyang branding ngayong araw. At ngayon, hindi na natin patatagalin pa para makadagdag sa kaalaman ng ating mga attendees mula sa Luzon, Visayas at Mindanao kung ano ang mga bagong tax policies na mayroon tayo ngayon dito sa Pilipinas. At bilang tugon sa ating nagbabagong panahon, opisyal na nating sisimulan ang programa sa pamamagitan ng isang doxology at ng Philippine National Anthem.
Times I feel still your mercy remains. Should I stumble again, still I'm caught in your grace. Everlasting, your light will shine when all else fades. Never ending, your glory goes beyond all fate.
Ayan, so probably one of the main reasons why we are together here in this Zoom meeting room is because we need a little push or to hear personal manifestations or encouraging insights from those who have actual experiences with regards to Philippine taxation. So aside from our amazing speaker for today who will be giving a talk, on interesting and relevant topics for us who are interested to learn. To officially open this space, let us give the spotlight to the University of the Philippines Visayas College of Management Dean, Attorney Christopher B. Honorario, a certified public accountant, to welcome our attendees for today's webinar and probably to give a bonus motivational tip for those who are interested to venture in the field of taxation in the future. So again, for our opening remarks, let us all welcome Attorney Christopher B. Honorario. Let's give him a warm round of applause, please.
Thank you. Thank you, Dea. Am I audible, Dea? Can you hear me?
Yes, po.
Okay. Sige, thank you. I hope I will be able to inspire and encourage them to pursue careers in taxation. Anyway, good morning, everyone. I am pleased to welcome all of you to this first installment of the 3-day webinar series entitled UPV Tax Lecture Series, organized by UPV JPIA in collaboration with the CM Student Council, Junior Executive Society, Marketing Society, Magnates, what else? And of course, our partner in all, I think almost all lecture activities, we have SGV and company, okay? Some students find taxation as an exciting topic. I know some hate it, no? And others, like our accountancy students, you have no choice but to love it. Okay. And then, well, taxation is even branded as the killer subject in your CPA board exam. Okay. So no matter how the idea of taxations, we have no choice. No, the importance of taxation. Of course, you've heard that taxation is the lifeblood of our government. Okay. I often hear feedback from our taxpayers of their unwillingness to pay the correct taxes. The reason is that these taxes anyway will go to the pockets of some politicians. No? And I hope that after this lecture series, we will be able to appreciate the importance of paying the correct taxes. No? And we will be able, you, the student, you will be able to educate the people around us the importance of paying the correct taxes and protecting or ensuring that the taxes that we collect are actually spent, for the purpose it was levied. Okay, so your role is to educate the people, and in order to protect the taxes, your role will be to elect the right leaders who will protect our taxes. So I hope that this series, no, I will leave the discussion and the detail of the taxes to our competent speakers. But I hope that after this lecture series, we will be in our own little way educate the people around us, no, about the importance of paying the correct taxes and protecting. I would like to emphasize protecting, the taxes that we pay. Okay, so you have a major role in protecting, no, these taxes. Okay, so I will have to ask apology siguro in advance to all of you. I cannot stay the entire session because of a scheduled exam and a meeting, but allow me to take this opportunity to extend our appreciation. Now, from the College of Management, we would like to extend our appreciation to SGV and company, to Sir Ace and the team, no, for sharing their knowledge and their valuable time this morning, and also to UPV JPIA and the rest, Marketing Society, Student Council, Junior Executive Society, for this, for the effort in organizing this lecture series. Okay, so congratulations everyone, and I look forward to your the effect on the effect and the impact of this lecture series to all of you. So I hope you will enjoy this 3 3-day webinar series. We have not yet scheduled the remaining, okay? But I hope you will enjoy and finish the entire lecture series. So again, good morning, everyone. And thank you, Dea.
Ayan, so maraming salamat para sa napaka-warm at motivational na opening remarks, Sir Tupe. Matapos nating marinig ang mensaheng iyon mula sa Dean ng UPVCM, hindi na natin patatagalin pa. Simulan na natin ang ating diskusyon patungkol sa taxation. So para sa ating tagapagsalita, siya ay nakapagtapos ng kursong Bachelor of Science in Accountancy sa University of the Philippines, Visayas bilang isang cum laude, Best Masters of Science in International Accounting and Finance with merit at University of Liverpool, United Kingdom. Siya ay kasalukuyang kumukuha ng Doctor in Business Administration in Aston Business School, Aston University, United Kingdom. Siya rin ay naging isang president ng PICPA Southern Metro Manila Chapter, 6th placer sa May 1996 CPA Licensure Examination. Siya rin ay mayroon ng 20 years of public accounting practice. At sa kasalukuyan, siya ay isang professional lecturer in taxation, financial accounting and reporting, auditing, management accounting at finance sa De La Salle University. Hindi na natin patatagalin pa para sa ating diskusyon patungkol sa Philippine taxation. Let us all welcome Mr. Aaron C. Escartin, Certified Public Accountant. Let us give him a virtual round of applause, please.
Okay, good morning, everyone. I hope that you can hear me clearly. Okay, so, well, thank you for that introduction. And then also thank you for Dean Tupe, for accommodating us also. And then, well, of course, it's also our initiative here. We collaborated with UPV in order to conduct this lecture. So this is actually part, of course, of our social responsibility in order to, well, impart knowledge also to the students. Because, of course, I know that as practitioners, well, we will be able to share with you how taxation is actually being practiced so that later on you'll be able to consider specializing in taxation. And then as mentioned also by Dean earlier, well, taxation is one of the most difficult subjects, well, in your CPA licensure examination. Well, I've also experienced that, but again, I'm actually specializing in taxation, and well, taxation was actually one of my lowest grades in the CPA exam. Okay, but anyway, I hope that after this session, and then after the series here, you'll be able to appreciate more taxation, and then you'll be able to apply this later on when you're working. And then I hope that this will also be helpful in taking your CPA licensure examination. Okay, well, of course, CPA licensure examination is actually multiple choice. Well, the objective here is not only, well, imparting knowledge for purposes of your CPA licensure examination, but later on, well, imparting this knowledge so that this will be helpful in your practice later on. Well, CPA licensure examination is just one hurdle, but on a long-term basis, you should be able to apply this, well, in your work later on, okay? Now, I'm going to share my slides. Okay, so I hope that you can see it already.
Yes, sir.
Okay, so for this particular session, for this morning, so this is the first series, we're going to cover here double taxation agreement. So I'm not really sure, well, of course, for those who are non-BSA students, well, I hope that you'll be able to, well, cope with our discussion. Well, this discussion may somewhat be technical, but I'll try to simplify it so that you'll be able to understand it. Well, of course, this also requires that you have somehow some understanding on the basic corporate income tax. Okay, so I think the first part here, we're going to discuss quickly here the basics of corporate income taxation, and we're also going to cover partly here individual taxation. Okay, so but those are only general rules. Okay, so as mentioned, we're going to cover double taxation agreement. Okay, so hopefully this will be helpful to you. So I'm not really sure if this is actually taught extensively in your taxation subject. Okay, but I know that for some schools, well, this is not actually extensively taught because based on experience, this may actually require actually practice so that you'll be able to impart knowledge about double taxation agreement. Okay. So this will be my discussion outline for this morning. So I'm going to cover here, well, firstly, as I mentioned, the general rules in Philippine taxation. I'm going to focus on individuals and then corporation. Okay, and then after that, we're going to start already with our discussion on double taxation agreements. Okay, so we're going to discuss here the concept of permanent establishment. This is actually relevant for purposes of determining the taxability of various payments that we're going to discuss later on. Now, if you're going to notice, our discussion here will actually focus on taxation of non-resident foreign corporations. So that's basically the focus of our discussion. So that's why we're going to cover here business profits. So these are the profits that are derived by foreign corporation in the Philippines. Then we're also going to cover here royalties, dividends. Sorry about that. Okay, so we're going to cover here royalties, dividends, interest, capital gains. Okay, and then the last part here, that's dependent personal services. So this will actually deal with individuals. So in this case, well, it's possible that an alien derives income from the Philippines. Okay, of course, well, what was taught here in the general principles of taxation or taxation of corporation and individuals for these foreign corporations and foreign or aliens, you know how are these actually taxed in the Philippines. But here, what we're going to do is, well, take into account the impact of double taxation agreements. So the Philippines has actually tax treaties with certain countries in order to, well, mitigate double taxation. So that's actually one purpose of entering into treaties with other countries. Okay, so this will be my discussion outline for this morning. Okay, now, so I'm going to start already with the lecture proper. So if you're going to look at the Philippine Tax Code, the Philippine Tax Code provides, well, a provision or has a provision and exclusion from gross income. It actually says there that if there is an income that's actually derived, and then there is also a treaty, and then the treaty provides for exemption, of course, the provisions of the treaty may actually prevail over the provision of the tax code. Okay, so this is also one of the relevant provision under the Philippine Tax Code. Okay, so in effect, if the Philippines has a treaty with a foreign country where the foreigner actually resides, well, you have to compare the provisions of the treaty with the provisions of the tax code, and then you're going to use the favorable provisions. Okay, so basically, the treaties provide for the maximum taxation or tax that will have to be imposed by a state. So in this case, we're going to take the point of view of the Philippines. Okay, so generally, when there are income payments, when foreigners derive income in the Philippines, you have to apply the Philippine Tax Code. But if there is a treaty, well, that provision of the tax code is, those provisions rather of the tax code are subject, well, to the provisions of the treaty. Okay, so effectively the treaties provide for a cap. Okay, now, so let's review first here the Philippine tax rules relating to taxation of individuals. Okay, so this will just be quick. Okay, so if you're going to look at the classification of individual taxpayers, okay, so there are actually 5 classifications. So we have resident citizens, non-resident citizen, resident alien, non-resident alien engaged in trade or business, and non-resident alien not engaged in trade or business. Okay, so if you're going to look at it, okay, if you're going to look at it, well, all taxpayers here except resident citizen are actually taxed only on their income within. Okay, but if you are a citizen, you're actually taxed on your worldwide income. And then if you're also going to look at it, okay, anyway, the slides that we are presenting to you are already updated while taking into account the impact of CREATE. Okay, so I hope that you know what CREATE is, diba? This is a new law that was enacted just this year, okay, changing or modifying the tax rates. CREATE and then TRAIN. Okay, the TRAIN law. So the CREATE law, this was enacted last year, or rather this year, and then effective also last year and then this year. With respect to the TRAIN law, this was enacted sometime in December 2017, and then this is effective 2018. So effectively, if you're going to look at the tax rates here already take into account, well, the changes under the train law, okay? Because these are individuals. So it's graduated from 0 to 35%, except for non-resident alien not engaged in trade or business, wherein the tax is 25%. Okay, later on in our discussion, okay, this will be the applicable tax rates. Okay, so in this case, we don't have any issues with respect to resident and non-resident citizens, but because they are not actually covered by the treaties between the Philippines and the foreign country, because they are citizens of the Philippines. But of course, if this non-resident citizen here derives income in a foreign country, or basically a resident citizen derives an income in a foreign country, well, there may be also tax relief in that foreign country. But we're going to take the point of view here of the Philippines, which means that, well, our discussion will only apply to resident aliens, non-resident aliens engaged in trade or business, and then non-resident alien not engaged in trade or business. But this will only be relevant later on for dependent personal services. So basically, this is for the last part of our discussion, okay? So basically, these are the more relevant rates that we're going to discuss later on. And then aside from that, these are also the other income items of individuals and then the relevant taxation. So basically what we did here is we focus on non-resident alien engaged and then not engaged. So if they are deriving interest income, so for engaged it's 20%, for not engaged it is 25%, for dividends, so if they have investment in shares in domestic corporation, okay, the dividend that they receive, it's 20% for engaged, and then for not engaged, it's 25%. For royalties, it's either 10 or 20%, okay, for engaged. Well, the default here is 20, but if you're actually deriving royalties relating to books and the like, so it will be 10%. But for not engaged, it's 25. And then capital gains, this will be for shares of stock, okay? So this is for shares of stock. So if they have investment in domestic shares and then they're going to dispose it, well, the capital gains that they derive, that will be subject to 15% CGT. And also for non-resident alien not engaged, it's also 15% capital gains tax, okay? So basically, if you have taken your income taxation, so I hope that you still remember these tax rates, okay? And then in your board examination, of course, you have to memorize these tax rates, right? Okay? Well, I'm actually part of the committee that, well, revised the syllabus for the CPA licensure examinations. In your case, well, you'll be taking the board examination maybe a few years from now. And then the new syllabus is actually effective October 2022 exam, okay? So with respect to the tax rates there, well, we did not actually change the rules relating to the tax rates for on the tax rules rather relating to when the tax rates will be given, okay? Except tax rates for real property tax, local business tax, excise tax, documentary stamp tax. Well, we actually explicitly stated there in the syllabus that it should be given during the examination, okay? But with respect to graduated tax rates, okay, just like this one, this will have to be given during the exam, okay? But for the other tax rates, you have to memorize it, which means that the tax rates here that are presented on the slides, you have to memorize this, okay? Now, let's go here to corporations. So for corporations, from a tax perspective, we have three classifications, right? So we have domestic, resident, and then non-resident. Now, when we say here domestic corporation, so this is also to clarify what a domestic corporation is. Because normally, okay, students and some staff that we have also has a understanding that if you are a foreign corporation, you will not be considered a domestic corporation, but a foreign corporation if you are a multinational company. That's not actually correct. Okay, when we say here domestic corporation, these are corporations that are incorporated in the Philippines. So which means that even if you are a wholly owned subsidiary of a foreign corporation, you are still considered a domestic corporation if you are incorporated here. Okay, so I hope that's clear. Because there are cases in which, let's say we have here company A. Company A here is incorporated in the Philippines. And this is 100% owned by company B. Okay, so 100% owned. So let's say, for example, company B here is a resident of Okay, let's say, for example, resident of the United States. So which means that company A is a multinational company, right? It's a wholly owned subsidiary of a US company. Okay, what is the classification here of company A for tax purposes? It is considered a domestic corporation because it is a subsidiary of company B, and then it is incorporated in the Philippines. Do you understand it? So I hope that's also clear. So if you are a domestic corporation, you are taxable on your income worldwide, and the tax rate is 20 or 25%. So of course, the default rate here is 25, but it can be lowered to 20%. So when will this be lowered to 20%? So this is already under the CREATE Act. So this is effective July 1, 2020, right? So with respect to the change in the tax rate. Okay, so when will 20% tax rate apply? If the total assets of this domestic corporation do not exceed 100 million, and then the taxable income does not exceed 5 million. So both of these requirements will have to be met so that the 20% tax rate will apply. Otherwise, the default rate of 25% tax rate will apply. Okay, so that is for domestic corp. Now, with respect to resident foreign corporation, when we say here foreign corporations, these are corporations that are incorporated abroad. Okay, so in this case, when will this be considered a foreign corporation? If this is not incorporated in the Philippines, so it could be a Philippine branch of this US company. So if company A here is a Philippine branch of this US company, then that is considered a foreign corporation. Okay, but is it a resident or a non-resident? Since it is a branch, it is a resident foreign corporation. Okay, but if there is no presence in the Philippines, that's considered non-resident foreign corporation. Okay, so for these foreign corporations, they're only taxable on their income within. For resident foreign corporation, the tax there is 25% flat. This is also under the CREATE. This is also effective July 1, 2020 rather. Now, with respect to non-resident foreign corporation, the rate is also flat, but this is effective January 1, 2021. Okay, so you have to take note of those dates. Okay, so these are just the general rules. So we are actually discussing this because later on we're going to incorporate this. We are going to take into account the provisions of the tax treaties. How will this actually affect the general tax rates that we have discussed? Okay, so I hope that this is actually clear. Okay, so let's proceed to the other income of corporations. Okay, so we're going again to focus here on non-resident foreign corporations because the treaties normally impact taxation of non-resident foreign corporations. So these non-resident foreign corporations may derive interest. So let's say, for example, they are lending money to a domestic company or to a Philippine resident. They are deriving interest income. The interest income that they derive normally is subject to 20. So this is interest and loans, but if that is other interest not related to a loan, that's 25. Dividends, the tax rate here is, the general tax rate is 25%, but it could be reduced to 15%. Okay, 15% here is under tax sparing. So when will 15% tax rate here apply? Okay, if the dividend is exempt in foreign country where the foreign corporation resides. Secondly, okay, when the foreign country allows tax credit, up to the extent of 10%. Okay, so basically, if you're going to look at here dividends, we have here foreign corporation. So this is non-resident foreign corporation. It has probably investment here in shares in domestic corporation. So this domestic corporation here pays dividend. So the dividend that this domestic corporation pays to the non-resident foreign corporation, it's subject to 25% tax rate. But if that is exempt in the foreign country where this NRFC resides, it will be 15%, or it could be taxable in that foreign country, but the foreign country allows tax credit of 10% relating to the dividends that's paid in the Philippines. So basically, this 10% pertains to the tax deemed paid in the Philippines. The tax rate will only be 15%. Okay, so examples here of countries in which it's exempt, in which the dividend that they derive in the Philippines are exempt. Examples here include Hong Kong, okay, Australia. Okay, now how about tax credit? Example here is United States. So basically, if NRFC here is a resident of the United States, well, it will be taxable in the US, but US tax laws allow tax credits, okay, equivalent to maybe 10%. So that's why you're only going to be the whole, or the dividend that this foreign corporation will be receiving in the Philippines will only be taxed at 15%. Okay, so I hope that's also clear. Okay, so aside from dividends, these foreign corporations also derive royalties. So that's taxed at 25%. Okay, let's say, for example, you are given a license, okay, license to use certain copyrights, trademarks, or certain formula in order to manufacture the products. And then you are paying a foreign corporation those royalties that will be subject to 25% tax. Now, capital gains. So this is also related to this investment. Now, if this foreign corporation disposes the investment in shares, any gain will be taxed at 15%. Okay, but this is only effective, well, from the effectivity of the CREATE Act. Okay, so this is effectivity of the CREATE Act is April 11, 2021. So prior to that, the tax rate here is 5%, 10% CGT, right? Okay, because this particular provision on 5%, 10%, well, I think the lawmakers actually missed this when they amended the tax code under the Train Law. So that's why they have actually corrected this when the CREATE Act was actually amended. Okay, so again, the effectivity of CREATE Act is April 11, 2021. Okay, but we're going to discuss this later when we go to the next series, okay, when we already discussed, well, the CREATE Act. Okay, so I hope that these general rules are actually clear because these are relevant again later on in our discussion. Okay, now, so we have here a poll question. Okay, so this is already an introduction to the tax treaties or double taxation agreement. Okay, so you have to answer this. It is an agreement under international law entered into by actors in international law. Okay, namely sovereign states and international organizations. So what's the answer here? Is it pact, truce, treaty, executive agreement? So I hope that you participate in the poll, ha?
%32 ang nakaka-vote. So others, yes, let's go.
Okay, please continue voting.
39. Okay, we'll wait kahit hanggang 50%. 47, 48, 49. Ayan, kaya pa ba higher? Mga 60, 51, 51%, 52, 54. Meron pa, 55, 56. Abutin natin hanggang 60. 55%, 56, 57. May 3% pa. Let's go. 57. Pero mukhang wala nang dumadagdag. So, 1, 2, ayan, 59. In the count of 5, 1, 2, 3, 4, 5. I'll end the poll and launch the results. Okay, wait. Kita na
Okay.
ba?
Okay, so, well, almost all answered treaty. So of course, the correct answer here is a treaty. Okay, so that's what we're going to discuss this morning. Well, taxation under the tax treaties. Okay, so let's go here to the next slide. Okay, so this is basically the definition of what a tax treaty is. Okay, international agreement. Okay, I think someone is not on mute. Okay, I'm actually hearing a sound. Okay. Okay, so when we say here tax treaty, it's an international agreement where states reciprocally agree to limit or modify application of domestic law to avoid international double taxation. So as I mentioned, the purpose of the treaty is to avoid international double taxation. Okay, and then it's actually limitation. So effectively, this is a cap, right? So this is what I'm actually telling you earlier. So the treaty provides for a cap, so which means that the domestic law cannot actually prevail over the treaty if the provisions of the domestic law are actually not as favorable as the provision of the treaty. So effectively, as I mentioned, it's the provision of the treaty or provision of the domestic law, whichever is favorable. Okay, that's how you're going to apply the taxation here of double taxation agreements. Okay, now these are the objectives of double taxation agreements or your tax treaties. Eliminate double taxation, but it does not entirely eliminate double tax. It could eliminate double taxation because even if the income is taxed in the Philippines, it's also taxed in the foreign country, but there is a tax credit mechanism. So in effect, it is as if you're just only paying one tax, right? Okay, so that's basically what we mean by elimination of double taxation. So it does not necessarily mean that it's also taxed here, it's also taxed abroad. Well, it's already double taxation because it's still possible that what the tax that's paid in the Philippines that can be credited in the foreign country. So if you're going to look at the total tax that's paid in the foreign country in the Philippines, it will just be equal to the tax that's imposed in the foreign country. Okay, so effectively, in substance, you are just paying one tax, although the tax is distributed between two states, the Philippines and the foreign country. Okay, so the objective is also to prevent fiscal evasion. Okay, so which means that if you are in the Philippines, you should be, if you are with respect to the domestic law, the domestic law here should not actually evade the tax that will have to be paid by the foreign country, by the foreign corporation. So enable cooperation between fiscal authorities, because there is also sharing information here between the Philippines and foreign country. Allocation of tax revenues between states. So this is what I'm actually telling you earlier, that it's possible that, let's say, for example, the total tax that you pay is 30%. So it's possible that only 15% or 10% is allocated to the Philippines. The other 30, the balance there is allocated to the foreign country. Okay, so this is foreign, this is PH, this could be foreign country because, or it could be 20, so sige, it's 30%, diba? So if it is 30%, it's possible that under the treaty, the cap is only 10%. But although in the foreign country, okay, you are imposed 30% tax, which means that in foreign country, you're going to pay 30% tax, but the tax that's paid in the Philippines, that can be deducted here against the tax that you pay in the foreign country. So in effect, you will only be paying 20% tax in the foreign country, right? So in effect, the total tax liability is still 30%. Still 30%, but it's allocated between the Philippines and then the foreign country. Okay, so this somehow also address double taxation, and at the same time, you actually agree on how tax will have to be allocated between the Philippines and the foreign country. Now, it also provides certainty to investors. Okay, how does it provide certainty to investors? Because, as I mentioned, the treaties provide for a cap, right? So which means that if there are amendments in the tax law, okay, so even if, excessive taxes are imposed on certain income, but there is a cap that's provided under the treaty, effectively, there is certainty on the part of the investor. So the investors here, the foreign investors here, are somehow protected, okay, because of the provisions of the treaty. But you have to take note that tax treaties only apply to income taxes, okay? So of course, the government can actually impose other taxes, like VAT, customs duties, and taxes. Okay, and then eliminate discriminatory taxation. Okay, so which means that there should be no favoritism. And then, of course, there could be political and then business reasons. Okay, you are actually entering into treaties with foreign country in order to improve your relationship, right? And then also for business reasons, because you want to attract investors to invest in your country. Okay, so it will also probably have an impact on foreign direct investments, which will further affect your or affect the Philippines' GDP. Okay, so in effect, there is economic reason for this. There is political reason for entering into tax treaties. Okay, so these are the objectives of having a treaty between the Philippines and the foreign country. Okay, now, if you're going to look at the BIR website, the BIR website actually enumerates what treaties or what countries the Philippines has treaties. Okay, so as of now, as of October 2021, there are 43 countries in which the Philippines has treaties. Okay, so you just have to probably take note of what countries are this. Okay, so in practice, we're actually referring to these tax treaties in order to determine the taxation of foreign corporation. Now, okay, let's go to polling question number 2. Okay, so this is also an introduction to the next topic. So it refers to a fixed place of business through which the business of an enterprise is wholly or partially carried on. Is it a branch, regional operating headquarters, permanent establishment, domicile? What do you think? So I hope that most of you will participate in the poll.
Currently 39%, so higher. Magkaya hanggang 50. 42%. 43. More. 45, 46, 47, 48, 50%. Okay, I think I can end the poll para launch na ang. So 45 out of 88 attendees.
Okay. Okay, so if you're going to look at the results, well, many still answered permanent establishment. Okay, but well, of course, the answer here is permanent establishment. So that's the next concept that we're going to discuss. So as I mentioned, that is actually relevant for purposes of well, determining the taxation of foreign corporation, the presence of permanent establishment in the Philippines. Okay, so answer PE. So we actually call it PE. Okay, so what do you mean by a PE? Okay, by the way, we are not actually discussing here certain specific provisions of, or we are not discussing here a specific provision of a treaty. Okay, we're using here a model. Okay, so basically, just to give you a background on what models are actually available, okay, for purposes of crafting the treaties. So these are the tax treaty models. So what are these? Okay, the first model is OECD model. Okay, so this is with respect to European countries. So it's organization of, I actually forgot the meeting, the Organization of European Cooperation and Development. Yan. So basically, this is an organization of European countries. But of course, there are countries which are not located in Europe that are also part of OECD. Okay, so OECD model. So we have also the US model. Okay, so it's actually apparent here that this is being used if you are entering a treaty with the United States. So you have to adopt the US model. And then we have also UN model. So UN model, that's United Nations. So which means that if you are entering into treaties with foreign countries, well, you can base the treaty with any of these models. But from a Philippine tax perspective, we are normally using here OECD model. Okay, so when we are interpreting the provisions of the treaty, we refer to how OECD model is actually interpreted. Okay, so I think you can download it from the internet. Well, the OECD model, and then there's also a commentary of each of the provision of the model. Okay, because of course the treaties only provide for the rules, And then sometimes, well, you need further clarity on how to interpret that provision. So if that's the case, you have to go to the commentary. So the OECD model that you can download from the internet, you can actually locate it there from the internet. There are commentaries on how to interpret the provision of certain treaties. So in practice, we also use the commentaries for purposes of interpreting the provisions, but because of course, sometimes there are complexities, well, in the transactions entered into by non-resident foreign corporations with a domestic company in the Philippines, okay? So our discussion here will actually use the provision of OECD model, okay? But later on, when we go to the specific problems, we're already going to refer to the specific provisions of the treaties. So we're going to somehow discuss here partly, well, some of the provisions of the treaties, the specific tax treaties, okay? Now, our discussion here will just be simple. We're not going to incorporate here complexities in interpreting the provisions of the treaty, since this is just basics of double taxation agreement. What we're going to do here, well, is to impart knowledge to you how to interpret the provisions of the tax treaty, okay? Basic only, okay? Now, so let's first discuss here the concept of permanent establishment. So as I mentioned, this is actually relevant later on. Okay, now what do you mean by permanent establishment? Well, it says there, an establishment, of course, that you set up in the Philippines, which is permanent in nature. Okay, so these are the elements. So a PE, well, means that there is an existence of place of business in the Philippines. Okay, it's actually a fixed place that you have in the Philippines, and you are actually using it in order to carry your business in the Philippines. So which means that you have an income that could be attributed to the PE, that could be effectively connected with the permanent establishment that you have in the Philippines. Okay, so this is the general definition. Okay, now, so basically, as I mentioned, the presence of a PE will have a significance on the tax implication of the income of the foreign corporation. Okay, now, if there is no PE, tax treaty will apply. But if there is PE, tax code will apply, you disregard the treaty. But of course, if there is no treaty, tax code will apply, right? So in effect, if we're talking about the presence of a permanent establishment in the Philippines, if that foreign corporation has a PE in the Philippines, you have to disregard the tax treaty. You have to focus on the tax codes, which means that what we're going to discuss this morning will not be relevant if there is PE. Okay, understand it? Okay, it is as if there is no tax treaty. So in effect, with PE and then no tax treaty, the taxation is actually similar. Okay, so I hope that's actually clear. Okay, so we're going to apply this all throughout our discussion. So it's really important that you understand this. Okay, so again, the provisions of the treaty will only apply if there is no permanent establishment. If there is PE, well, disregard the provision of the treaty. Okay. Now, so this is an enumeration of what will constitute permanent establishment under the OECD model. But of course, if you have a specific transaction, you have to refer to the specific treaty, not the OECD model. We're only using here the OECD model for purposes of our discussion, huh? You should not actually use it for purposes of, well, determining the taxability of the transaction. But of course, if there are certain complexities on the transaction, and then it's not clear in the tax treaty, okay, on how to interpret a specific provision or on what specific provision will be applicable, then you may have to refer to the commentary. Okay, but again, as I mentioned, we're not going to do that here. Okay, so when we say here permanent establishment, it's a place of management that you have. If you are maintaining a factory in the Philippines, that's also a PE. If you have a workshop here, that's a PE. If you have a branch, okay, that's a PE. You have an office, so let's say a representative office, that's also a PE. Or if there is someone acting on your behalf or on behalf of the foreign corporation, that's also considered a PE. So which means that it does not necessarily mean that there should be, what you call this, an office, there should be a branch, okay? There should be a factory that you set up here. So if someone in the Philippines is acting on behalf of that foreign corporation, that's considered a PE. Or it's possible that you are engaged in construction, you have a building site or installation project here, that's also considered a PE. But normally there is a number of days requirement here, so that will constitute a PE. Now, it also includes extraction of natural resources. If you're engaged in mining, okay, and then you're extracting natural resources in the Philippines, that may constitute a permanent establishment. So if any of this is present, probably you have a PE. If that is the case, disregard the provision of the PE of the tax code, or rather disregard the provision of the tax treaty. Okay, so I hope that this is actually clear. Okay, so these are other, well, ito kasi specific inclusions. So what are exceptions? Okay, so if you have this in the Philippines, this may not be considered permanent establishment in general. So if you have facilities for goods or merchandise storage, display, or deliveries, which means that you have a facility here wherein you just store the goods, that may not constitute PE. Okay. So goods or merchandise maintenance for storage or display. Okay, somewhat these two are similar. So goods or merchandise maintenance for processing by another enterprise. So which means that if you're storing goods in the Philippines that will be processed further by another entity, well, that storage place here in the Philippines may not be considered a permanent establishment or place of business maintenance. Okay, so basically, if you're going to look at it, you are just storing the goods here. You have only place of maintenance. You are not actually deriving income in the Philippines. Okay, you are actually maintaining this goods for storage. That may not constitute a Philippine PE. Okay, so that is these are some of the exceptions. But of course, again, as I mentioned, you may have to refer to the specific provisions of the treaty on what will be the inclusions and what will be the exclusions. Okay, so you have to take note of this definition. Okay, so I hope that you somehow absorb what we mean by permanent establishment. Okay, now, so let's have here a polling question. So in general, double taxation agreements are applicable to, okay, what tax? VAT, income tax, doc stamps, all of the above. I've actually mentioned this earlier, right? Okay.
30%. So yes, vote pa yung mga hindi nakaka-vote. %. Konti pa. Let's paabot sa 50. 43, 44, 45, 46. 4% more. 47. 48. Okay. Last two. Okay, ayan. Sige, I'll end the poll.
Okay, so as I mentioned earlier, the provisions of the treaty will only be relevant for income tax. So it does not actually cover VAT, doc stamps, and any other taxes. It's only limited to VAT, to income tax. Okay, so I hope that's clear. Okay, so that's basically polling question number 3. Okay, now, so we have already discussed PE. So we're going to discuss next here, well, the specific taxability of transactions. So we're going to start with business profits. So basically, when we say here business profits, that's an income derived in carrying on an enterprise in the Philippines. So the foreign corporation, well, derives income in the Philippines that may constitute business profits. Okay, so what is the exclusion from the definition of business profits? So we have dividends, royalties, interest, and then other and capital gains and other income that has actually a specific provision in the treaty. Okay, so if an income is covered by other articles in the treaty, that's not considered business profits. In effect, when we are talking about business profits, this is a catch-all provision in the treaty. So which means that if you cannot find a provision in the treaty that covers a specific income that will be considered business profits. Do you understand it? Okay, so catch-all provision yung business profits. So basically, how will these business profits be taxed? So that's what we're going to discuss now. Okay, so this slide actually provides you a summary of the taxation of business profits. So we have actually summarized here how to interpret the provision of the treaty. So this is in general applicable well to all treaties. Okay, so effectively, if you are deriving business profits, so if you're going to look at it, we're actually going to focus on services because normally foreign corporations here are deriving income from services rendered in the Philippines. Okay, because if those are, of course, relating to goods, normally it's actually imported, right? So if a Philippine resident buys goods from a foreign corporation, it will be through importation. So that may not necessarily create an issue relating to taxation of foreign corporations. So taxation of foreign corporations may be relevant here, okay, relating to services that are rendered. Okay, so that's why our discussion will focus on services. So the first question that you're going to ask here, if the foreign corporation derives business profits, is that, are the services rendered within? Remember earlier when we discussed taxation of foreign corporation, okay, non-resident foreign corporation, they're only taxed on their income derived within, right? Okay, so that's why if these are not rendered within, that's considered tax exempt because they are not taxed on income derived from sources within the Philippines. Okay, remember, if you're talking about services, the situs of taxation there is where the services are rendered. Okay, so if the services are rendered within, that's considered income sources within. If the services are rendered outside, that's considered income without. So that's why it's tax exempt if those are rendered without. Okay, now, if the services are rendered within the Philippines, the next question that you're going to ask is there a treaty between the Philippines and the foreign country where the non-resident resides? Okay, if there is no treaty, effectively tax code will apply. So this is tax code, right? So if it is tax code, the rate now is 25%. Okay, so here, this is just what was taught to you in your income taxation. Now, this is the impact of the treaty. So if there is a treaty between the Philippines and the foreign country in which the non-resident resides, you have to ask whether there is PE. Okay, so if there is PE, you don't consider the provision of the treaty. That's why it's 25. So if you're going to look at it, this is similar to this, right? So these two are actually similar, are the same. Okay, because this apply the tax code. So tax treaty will only relevant if there is no PE. So under the tax treaty, well, if there is no PE, the income is tax exempt. Do you understand it? So the business profits here will be exempt, well, in the Philippines. So that will not be subject to Philippine income tax, but there may be VAT implication. But our discussion here will only focus on income tax. Okay, so this is exempt from income tax. Okay, so I hope that you understand this slide because we're going to apply, well, the same principle here later on. So kapag naintindihan mo to, somehow you'll be able to understand also the other payments later on or the other income items. So I hope that, well, you will be able to appreciate or understand this particular slide. Okay, so let's have an example. So we're going to illustrate here how to apply the provisions of the treaty, how to actually apply this particular diagram. So if you're going to look at it, this is a decision tree, right? So you just have to understand this decision tree in order to determine the tax implications of certain transactions. Okay, so let's have here an example. So this example, well, illustrates if there is no permanent establishment. Okay, Sansa Corporation, a company domiciled in the United Kingdom. So we have a treaty with UK. Rendered administration and accounting services to Arya Company, a domestic corporation. So this is PH. Okay, so this is UK. which commenced on January 1, 2021. January 31, 2021. SANSA sent 3 employees to render the services in the Philippines. So ARIA paid 500,000. Okay. So employee A and B, they were here in the Philippines from January to March. So how many days will this be? So January, you have to count the exact number of days, hindi siya number of months, because if you're going to look at later on the limits on permanent establishment, although we did not discuss that earlier because well, the OECD model does not actually provide that specific provision. If you're going to look at the treaties, they normally provide their number of days that the employees are here in the Philippines. Okay, so if you're going to look at January to March, this is somehow around ilang days ba to? So probably this is 28 days, right? Okay. No, 28. So for January, February is actually 28, and then March is 31. So it's around, tama ba? It's 59 days. Okay. So although there are 2 employees, since they are present here in the Philippines at the same time, you just have to count. Well, you don't actually multiply this by 2. Okay. So para sa isang araw, isa lang din yun, di ba? Although they are both here. Okay. Now, employee C, April 15 to June 15. So probably for April, we have 15, May 31, and then June, we have also 15. So how much will this be? So this will be 61, right? So 61 plus 59. So they are here for 120 days, right? Okay. So they are here for 120 days. Later on, this will be relevant, well, for purposes of determining whether SANSA here as a Philippine PE. Okay, so if you're going to look at the situation, so SANSA, this is UK, rendered services to ARIA. So administration and accounting services. And then in consideration for the services rendered, ARIA paid SANSA service fee of 500,000. So these are the questions that we need to answer. How much is the final withholding tax liability of ARIA for the year ended December 31, 2021? So we are talking about FWT. Final withholding tax. This is actually a tax that's withheld by ARIA on the income that's derived by SANSA. Remember, foreign corporations do not have presence in the Philippines, right? So there is no way that they'll be able to remit the tax to the BIR. So the mechanism there is that the one that pays this foreign corporation will have to remit the tax to the BIR, right? So that's why it's final withholding tax. So this is actually a tax that's imposed on the income of SANSA. Okay, but this is remitted by ARIA. So this is a tax on SANSA, but remitted by ARIA. So we're going to determine here how much tax is imposed on SANSA, which will be remitted by ARIA. And then how much is the net payment made by ARIA? Remember, this is a tax on SANSA, so which means that when ARIA here pays SANSA, it should already be net of tax. So it's possible that it's not the entire 500,000 that will have to be paid to SANSA, but a portion of this may be remitted to the BIR, representing the tax on SANSA. Okay, so that's why we are actually going to answer here how much will have to be paid net here to SANSA. Okay, so this is basically what transpired. So we're going to evaluate, well, the taxability of this 500,000. Will this be taxed in the Philippines? Okay, so let's look at the provision of the treaty, because I hope that you'll be able to follow, huh? So if you're going to look at Article 7 of RP-UK Tax Treaty, it says there that the profits of an enterprise of a contracting state shall be taxable only in that state. So when we say a contracting state, so of course this is from the point of view of the Philippines, this is actually United Kingdom. Okay, shall only be taxed in UK unless the enterprise carries on business in the Philippines. So ibig sabihin, it will be taxed in the Philippines if the UK company here has PE in the Philippines. Okay, so through a permanent establishment situated in PH, diba? If you're going to recall our flow chart, the flow chart is actually based on this provision. So if the enterprise carries on business as aforesaid, the profits of the enterprise may be taxed in the Philippines, but only so much of them as is directly or indirectly attributable to that permanent establishment. So we're not going to discuss here the concept of attribution. Okay, we are going to assume in our discussion that the profit here is attributable to the PE. Okay, but of course, in practice, there is an issue on attribution. Okay, because sometimes, although there's PE, is the income attributable to the PE. Okay, but we're not going to discuss it here. So again, our assumption here is that if there is PE, we assume that the income is attributable to the permanent establishment. So if that is the case, the income will be taxable in the Philippines. Okay, so applying this provision, okay, before I proceed. So this is also a definition of what a PE under UK. Okay, so this is the more relevant provision. So it says here that an enterprise of a contracting state, so this is UK, shall likewise be deemed to have a permanent establishment in the Philippines if it carries on supervisory activities within that other contracting state, so PH, more than 183 days in connection with, well, this is in connection with building site or construction or assembly project, which is being undertaken in that other contracting state, so Philippines. So this is not applicable because we're not talking about building site, right? We're talking about services. So this is applicable. It furnishes services, including consultancy services. So it says here, services. So which means that the services that's rendered by SANSA may actually fall under B, okay? In that other contracting state, so PH, through its employees, okay, for a period exceeding in aggregate 183 days within any 12-month period. Okay, so if you're going to look at our example, how many days were the employees of SANSA were here in the Philippines? They were here for 120 days. So which means that there is no permanent establishment, right? But if this is actually breached, then SANSA will be considered to have a PE. So I hope that you follow, huh? That's how you're going to interpret the provision of the treaty. Okay, so applying this in the flow chart that you have prepared earlier. So are services rendered within? Yes. Okay, next question. Is there a treaty? Yes. Is there a PE? No, because it's only 120 versus 183. So that's why the income of SANSA is tax exempt. Okay, so I hope that you follow. Okay, so there's no final tax, net payment. It's the full payment of 500. There's no deduction because there is no PE. The employees were here in the Philippines only 420 days. Okay, so I hope that you got the answer here. Okay, so nasusundan ha? Okay. So basically, siguro, perception nyo pa rin, tax is difficult, but if you actually understand the principles, it's actually easy. Medyo dekahon siya, but of course, if the complexities will come in because companies have complex transactions. But if the transactions are just basic, then it's just actually easy to do it. Okay, so I think what makes taxation difficult is that when you studied accounting, di ba, yung basic accounting nyo kasi, it's not tax accounting, but it's actually financial accounting. Okay, that's why when tax rules are introduced, medyo nalilito ka na. Pero kapag tingin ko, kapag tax siguro yung unang tinuro, baka baliktad yung mangyayari, di ba? Okay, but of course, since we are accountants, so syempre, we have to understand first financial accounting, and then later on, we were actually taught here tax rules. Okay, so basically, if you know the basic tax rules, well, interpreting the provisions of the tax laws and regulations may just actually be easy. What makes this complex is when you actually encounter complex transactions. So if you're going to look at our discussion, di ba? Kapag naintindihan mo to, this is just actually easy because there's no complexity yet here in the transaction that we are discussing. Okay? Di ba? Straightforward yung taxability niya, di ba? So I hope that you somehow understand it, and then I hope that you also appreciate what you have actually discussed. Okay? So let's proceed next. So this is basically what happened. So ARIA will pay SANSA in full 500,000. There's no payment to the BAR because this is actually exempt from Philippine income tax. Okay, So let's have another example. This is with PE. So Sansa Corporation, a company domiciled in UK, rendered administration services is actually the same. Okay, but what changed here will be on the number of days. So if you're going to look at this one, this is 59 days, right? So how about June? Parang may mali yata dito. So June, July, August. So June 15, July, August, September 15. So if you're going to total this, how much is it? So 5, 10, 12. So 3, 4, 5, 6, 7, 8, 9. 92 plus 59. How much is it? So 9, 11, 9, 10, 151. Tingin ko may kulang to. Okay. Kasi 151 yan eh. So we're going to change this. Okay. So let's, ano ba yung kanina na original? April. So we're going to change this to April. Okay. So this should be April. So if this is April 15, so from April, May, and then June kanina cut off natin, di ba? So we're going to add this. So 5, 10, 11, 3, 4, 5, 6, 61. So we're going to add here 61. 151 plus 61, so 2, so 212. So this should be 212. So instead of April, this should be June. Okay, so in this case, the employees were here in the Philippines for 212. Okay, is there a PE? Yes, diba? As mentioned earlier, under UK treaty, the limit is only 183 days, right? So versus 212, there is a PE. Okay, so again, it's the same. Okay, and then this is just a similar provision that I've actually explained earlier. And then this is the definition of a PE. So as mentioned, it's 183, but the actual number of days, 212. Okay, so in this case, there is PE. So that the payments here to the foreign corporation, to SANSA, will be subject to 25% final tax. So I hope that you understand the distinction, ha? Kanina kasi exempt. Ito, naging taxable because of the number of days. Okay, so which means that, well, if you are entering into services, if you're entering into agreement with foreign corporation, probably you have to manage a number of days stay that the employees are here in the Philippines in order for those to be tax exempt. Okay, but again, that's only from a Philippine tax perspective because it's still possible that it's taxed in foreign country. So pwedeng indifferent ka, di ba? On the part of the foreign corporation, because although it's taxed in the foreign country, it's possible that this 25% tax that's paid in the Philippines, it's credited in the foreign country. So effectively, on the part of the foreign corporation, it's possible that they are actually indifferent kasi the total cash flow will still be the same regardless of where you actually pay it. Okay, so I think it's just a matter of to whom are you going to pay the tax? Are you going to pay the tax to the Philippines or are you going to pay to the tax in the United Kingdom? But of course, it depends on the laws of United Kingdom. Okay. Now, so this is how the tax will be calculated. So the tax rate is 25%. This is tax code. Okay. So in this case, it's 125,000. So when ARIA pays SANSA, it will only pay 375 because 500,000 will have to be reduced by 125. So this goes to the BIR. This goes to SANSA. Okay, so there is PE because the employees were here in the Philippines for 212 days. Okay, so I hope that you got this. So to further illustrate, this is actually what happened. So ARIA pays SANSA 375, and then ARIA will issue BIR Form 2306. This is certificate of final tax that will have to be issued to SANSA. SANSA may be able to utilize this depending on the laws of United Kingdom because this can be utilized as foreign tax credit. So effectively, 2306 here will contain 125,000. So in effect, when ARIA pays SANSA, there's cash of 375 and then there's certificate of 125. So effectively, it's still a total of 500. So the certificate can be probably used as tax credit in United Kingdom by SANSA. Okay, and then ARIA here is constituted as the withholding agent. It will remit the tax on behalf of SANSA. It will file BR Form 0609F or 1601FQ okay, when paying the tax to the PAR. So syempre, di ba, in your case, you have to familiarize yourselves also with the tax forms because in board examination, these tax forms also come out. Okay, of course, in practice, well, you'll be encountering all these tax forms. Okay, so sa practice naman kasi paulit-ulit mo kasing ginagawa yan. So there's no need for you to memorize it. Okay, so in your case, since you're still students, well, you have to memorize, you have to familiarize yourselves with these tax forms, with the tax rates. Okay, so I hope that you know the distinction between PE and then without PE. Okay, sige. Let's have a polling question. So this one, this is relating to royalties. Okay. Sige. So true or false? The most favored nation clause allows taxpayer to avail of more liberal provisions granted in another tax treaty to which a taxpayer's country is also a party. If there is permanent establishment tax treaty, this is second statement pala. So the first statement is relating to most favored nation clause. Siguro this is still foreign to you. Okay, number 2, if there is permanent establishment, tax treaty rates will not apply. Okay. So syempre, you know what, you should know the answer, that's the second statement here, whether it is true or false, because we have been discussing this. If there is PE, tax treaty rates will not apply. Okay, the first one that is relating to most favored nation clause that is applicable to royalties. Okay, that we're going to discuss next. Okay, so 26%, 28, 30, 30. Okay, while you are answering, okay.
40%. So,
Okay,
yeah,
mag-break mo
kaunti
ako sa
pa.
dali
More votes pa. 40% pa lang. Let's go. Okay, I'll stop the poll and launch the results.
Okay. Okay, so, well, 45% here answered both statements are true. Okay, so what do you think will be the answer here? Well, of course, with respect to second statement, as I mentioned earlier, well, I've actually explained it, right? Okay, now with respect to most favored nation clause, this is also true. So basically, when we say here most favored nation clause, the treaty does not actually provide for the rate. It just actually says that the rate that will have to be used is the lowest rate. Okay, the lowest rate that's actually contained in other tax treaties. So that's what you mean by most favored nation clause. So this most favored nation clause here, this is actually applied U.S. tax treaty relating to royalties. Okay? Okay, sige. Let's go tier 2, taxation of royalties. When we say here royalties, these are payments for use or right to use of any copyright of copyright of literary, artistic, or scientific work. It may also include cinematograph films, patent, trademark, design, model or plan, secret formula or process. So this is basically what's provided under OECD. But sometimes there are also treaties in which use or right to use of equipment is included. So which means that if you're leasing an equipment, that may be considered also as royalties. Do you understand it? Okay, kasi di ba normally when we say royalties, those are just basically license. You are provided a license in order to use the formula or to use a patent or the trademark. Okay, but in certain instances, lease of an equipment may also be considered royalties. Again, it depends on the provision of the treaty. There are treaties in which lease is not considered a royalty. There are provisions in which lease is considered royalty. Okay, so we're going to discuss that partly in a while. Okay, now, similar to business profits, we have also similar flowchart here. Okay, but this is quite simpler. Okay, now, basically, the first question that you're going to ask here is whether there is a treaty between the Philippines and foreign country. So if you're going to observe with respect to business profits, there is a question there whether the services are rendered within or without. Okay? But here, this is not actually contained, diba? Wala tayong question here whether this is within or without. Why? Because if you're going to look at the situs of taxation of royalties, well, it is where you transfer your know-how or technology or equipment. If you are, so in this case, since a non-resident foreign corporation has transaction with a PH company, in effect, the know-how or technology here is actually being used in the Philippines. So which means that it is assumed that if you are paying royalties, that's already taxable on the part of the foreign corporation because the technology, the know-how is used in the Philippines. So effectively, the foreign corporation is considered deriving income from sources within the Philippines. So I hope that you understand the distinction between services and royalties. That's why in practice also, there are cases in which it's not clear whether the services qualify as royalties. Okay? Kasi syempre, kapag royalties yan, it does not matter where the services are rendered. Okay? Since it is being used in the Philippines, that's considered income derived from sources within the Philippines by the foreign corporation, even if, well, no employees were sent in the Philippines. But if we're talking about services, someone will have to be sent to the Philippines to render the services, right? Okay, so again, as I mentioned, here we do not ask a question whether the services are rendered within or without. Okay, for as long as there are royalties, well, the income may be considered already derived from sources within the Philippines. So if there is no treaty, tax rate is 25. But if there is treaty, we have to ask whether there is PE or no PE. So if there is PE, automatic, it's 25%, right? So basically, this one, and this one are the same, right? Because this apply the tax code. But if there is treaty, or rather, if there is no PE, the provisions of the treaty will apply. Normally, the treaty provides for a tax rate of 10, 15, or 25% for royalties. So effectively, if the tax rate is 25%, well, that's already maximum rate under the treaty. This is the maximum rate under the treaty, okay? And then the tax code also imposes 25%, so which means in that case, it does not matter whether you're going to apply the treaty or the tax code. But if the tax rate is lower than 25%, of course, it's beneficial for you to apply the treaty rate, right? Okay, so let's have an example. So this illustrates without PE. Okay, so Lannister Corporation, a domestic corporation, entered a technical service agreement with Greyjoy, a resident of Singapore. So there is also a treaty with Singapore where Greyjoy will render technical services. So if you're going to look at the technical service agreement, normally, if there is a technical service agreement, well, it is already apparent that these are for royalties. So which means that you are transferring here technical know-how that may constitute royalties. So our assumption here is that these technical services are considered royalties. That's the assumption that we have. Huh? Okay, Greyjoy sent employees to the Philippines to render the related services for 150 days. So this is relevant for purposes of determining whether there is a PE. Okay, now technical service fees paid for the year amounted to 250,000. So how much is the FWT liability of Lannister for the year ended December 31, 2021? Okay, we have two assumptions here. Lannister, a Philippine entity, is BOI registered, engaged in preferred areas of activities, and then another assumption, not BOI registered. How much is the net payment? So similar to business profits, we're also going to answer, well, how much will be the net payment? Okay, now, what's the significance here of BOI and not BOI? Normally, there are treaties in which if the domestic company here is engaged or is registered with BOI and engaged in preferred areas of activities, well, they are given, well, certain tax relief. So they're actually given that the tax that can be imposed here could actually be lower. Okay, so that is an additional incentive if you're registered with the Board of Investments, engaged in preferred areas of activities. When we say here BOI, strictly BOI lang talaga yan, ha? This does not include PEZA. Okay, you should be registered here with the Board of Investments and then engaged in preferred areas of activities. Okay, so this is the diagram on the transaction. So there's a technical service agreement entered into between Lannister and Greyjoy. So Greyjoy sent employees in the Philippines for 150 days. So this is to determine whether there is PE. And then Lannister pays Greyjoy. So Greyjoy, Singapore. This is PH. Okay. So let's check the provisions of the treaty. So if you're going to look at royalties, okay, the provision of royalties, it provides there a definition of what royalty means. So royalties, as used in this article, means payments of any kind received as a consideration for the use or right to use any copyright of literary, artistic, or scientific work, including cinematographic films or tapes for television or broadcasting, any patent, trademark, design, or model, plan, secret formula, or process. Okay, so basically we have here use or right to use. So probably in this case, it's technical. It could be a process that's contained in the technical service agreement, right? Okay, and then if you're also going to further read the definition, it says there for the use of or the right to use industrial, commercial, or scientific equipment. So in this case, this is lease of equipment. So if you're going to apply treaty with Singapore, lease of equipment is considered royalty. But if this provision is not present, then lease of equipment will be considered business profits. Do you understand it? So I hope that you know the distinction here. Huh? So in effect, lease of equipment here, okay, can either be considered business profits or royalties. So if the definition of royalties include use or right to use equipment, then lease of equipment will be royalties. But if the definition of royalties do not include right to use equipment, then that will be considered business profits. Well, anyway, if these are considered royalties, the lease of equipment is subject to 7.5% final tax. Okay, hindi pala ito nasama kanina, di ba? So if lease of equipment, that's subject to 7.5% final withholding tax. Okay, and then the last phrase here for information concerning industrial, commercial, or scientific experience. So effectively, the third technical service agreement that's entered into between the entities could also contain information concerning industrial, commercial, or scientific experience. That's why kapag may word that technical, it's possible that that may already be considered royalties. But again, for purposes of our discussion here, we assume that those are royalties. So in practice, you have to really evaluate whether the technical service agreement will be considered royalties or business profits. Okay, but we're not going to do that here. Okay, now, with respect to taxation of royalties, the provision of Singapore Treaty also provides that Royalties arising in a contracting state and paid to a resident of other contracting state may be taxed in that other state. Okay. And then second provision here, such royalties may also be taxed in the contracting state in which they arise. Ito kasi arising in a contracting state, so this is Philippines, paid to a resident of Singapore, may be taxed in Singapore. So syempre, it should be taxable in Singapore. That's a general rule. Okay, so this is the more relevant provision that we're going to apply. So such royalties may also be taxed in the contracting state in which they arise. So this is Philippines. And according to the law of that state, so Philippine laws, so which means that if the royalties will be taxed in the Philippines, okay, but the tax here will not exceed these rates, okay? So, but if the recipient is the beneficial owner of the royalties, the tax so charged shall not exceed. So these are the maximum rates. So if you're going to look at letter A, it says here, in the case of the Philippines, 15% of the gross amount of the royalties, where the royalties are paid by an enterprise registered with the Philippine Board of Investments engaged in preferred areas of activities. Okay, so that's one. And then second, if the royalties are in respect of cinematographic films or tapes for television or broadcasting. So in the situation that we have, well, 15% rate here may apply if the company is BOI registered, engaged in preferred areas of activities. Okay, so this is Singapore, so this is not applicable. But if you are not BOI registered, engaged in preferred areas of activities, the tax rate will be 25. Okay, so it's the same as a tax code. Okay, so we're going to analyze further what tax rate we're going to apply. Okay, so the furnishing of services, ito naman, this is definition of permanent establishment. We're going to evaluate whether Singaporean entity has PE in the Philippines. Remember, the employees were here in the Philippines for 150 days. Will this constitute a PE? So it says here, the furnishing of services, including consultancy services by a resident of one of the contracting states. Okay, so this one, resident of Singapore, through employees or other personnel, okay, provided the activities of that nature continue within the other contracting state, Philippines, for a period or periods aggregating more than 183 days. So if this is the case, since we're talking only of 150 days versus 183, there is no permanent establishment. Okay, so I hope that you understand. Nasusundan nyo, ha? Okay. So, again, so applying the flow chart. So is the non-resident foreign supplier a resident of treaty country? Yes. Is there a PE? No. So that's why the rate will either be 15 or 25% under the Singapore tax treaty. Okay, so if this is the case, if it is BR registered entity engaged in preferred areas of activities, dapat engage in preferred areas of activities, ha? Because there are also BR registered entities that are not engaged in preferred areas of activities. If that's the case, it's the 15% tax will not apply. So the 15% tax here will only apply if the company is a BOI registered entity engaged in preferred areas of activities, because that is what is provided under the treaty. Okay, so in this case, the tax rate will be 15%. So 250 times 15, that's 37,500. Okay, so effectively, instead of paying 250 there to Singapore, you're only going to pay 212 because 37,500 will go to the BIR. So this is Singapore entity. Okay, so there is no PE because it's only 150 days. Okay, so I hope that you understand this. So this is the diagram on the cash flow. So Lannister will pay Greyjoy 212,500. And then in addition, it will issue BR Form 2306 containing 37,500. And then 37,500 will be remitted to the BIR by filing this BIR forms. Okay, so I hope that this is clear, ha? So sana nasusundan nyo. I know that somehow this is heavy, but I hope that you are appreciating what we are discussing. Okay. So, paano naman kapag walang PE? Well, this is if the company is not BOI registered pala. If it is not BOI registered, the tax rate will be 25%. Okay? So instead of 15, we're going to use here 25. So it will be 62.5. So similarly, we deduct 62.5 plus from 250. Well, the net payment will only be 187,500. So similarly, there's no PE. Okay? So this is basically the cash flow diagram. So Lannister pays 187,500 to Greyjoy, and then Lannister pays to the BIR 62,500. Okay. Sige, let's have another illustration if there is PE. So similar situation, except that Greyjoy sent employees in the Philippines for 200 days, diba? Versus 183 days. So in this case, there is already PE, right? Okay, similar situation. So what will be the answer here? Okay, so this is still the diagram. Okay, this is the provision of the tax treaty relating to royalties. So this is the tax. This is the provision relating to the tax rate. We discussed this earlier. And then this is a definition of a PE. So this is the 180-day threshold versus 200. So there is PE. So in this case, using the diagram, since there is PE, 25% tax rate will apply. We're going to disregard the provision of the tax treaty. So the tax will be 62,500. Net payment will be 187,500. So this is actually the same, okay, if there is no PE and then not BOI registered. Diba yun yung sinabi ko kanina, that with respect to Singapore tax treaty, and then the recipient, or rather the payer of the royalty, is not a BI registered entity, you are actually indifferent. We're going to apply whether you're going to apply the treaty or the tax code. So in this case, this is a tax code rate, diba? Tax code 2, which is actually equal to Singapore treaty, okay, for non-BOI. Okay, so similarly, this will be your cash flow diagram. Okay, so that's royalties. Okay, so I hope nasusundan nyo, ha? Sige, let's go next here to dividend. Okay, what is the taxation of dividend if you're going to apply tax treaty? Okay, let's discuss here quickly first. Well, what do you mean by dividends? So this is an income from shares participating in profits. So effectively, you have investment in shares. So as return from your investment, you are receiving profit share. So the profit share that you receive, that's actually considered dividend. Okay, and then income from other corporate rights. Exclusion here, income from shares being debt claims in nature. Okay, so sometimes from a tax perspective, we're also applying substance over form because it is possible that it is characterized as a debt, or rather as an equity. But if you're going to look at the substance, it's actually a debt. Okay, so if that is the case, well, that dividend will not be considered as dividend, but it will be considered interest. Okay, but of course, in our discussion here, we assume that there is no issue on the nature of the dividend. Okay? So kapag pwede mo sabihin, sometimes the rules here in accounting may also be applicable. Okay? But normally, from a tax perspective, we're actually adopting the legal form. Okay? But there are certain cases in which we disregard the legal form. We're also applying here substance over form. Okay. So this is actually the flow chart relating to dividends. If you're going to look at it, this is somewhat busy. What makes it busy is relating to the tax pairing. Okay? May tax pairing kasi siya. Kung walang tax pairing yan, it's actually similar to royalties. Okay? So, the first question that you're going to ask here is whether the investor is a government institution. If the investor is a government institution, the dividend that's being paid to that government institution is tax exempt. So foreign government, okay, normally the dividend there is exempt. But if the investor is not a government, of course, that's the time that you're going to ask whether there is a treaty. Okay, because basically this is tax code to eh. Okay, under the tax code, a foreign government deriving dividend income, that's actually exempt from Philippine income tax. Okay, now, if the stockholder is not a government, you're going to ask whether there is treaty or no treaty. If there is no treaty, we're going to apply the tax code. So this is tax code, right? So earlier I've discussed tax pairing, right? If there is tax pairing, it's 15. If there is no tax pairing, it is 25. Now, if there is a treaty, you're going to ask whether there is a PE. Okay, if there is PE, disregard the treaty. That's why we're going to apply tax code. So the question here is also similar to this one, involving tax pairing. If there is tax pairing, 15, no tax pairing, 25. Okay, but if the stockholder does not maintain a PE, the tax rate could be 10, it could be 15, it could be 25. Okay, so similar to royalties, diba? So again, this is dependent on the provision of the treaty. Okay, let's have an example. White Walkers Philippines Inc., a domestic corporation, is a wholly owned subsidiary of Wildlings Corporation, a Norwegian entity. So we have also a treaty with Norway. So White Walkers declared and paid dividend of 1 million during 2021. So in this case, we don't have any information relating to a PE. Siyempre, we're talking about investment, right? So if we're talking about investment, well, that may not be, the PE issue here may not be relevant because normally it's a direct investment from a foreign corporation. Okay, but in this case, we are also assuming that there is no PE. Okay, so how much is the FWT liability of White Walkers? And then how much is the net payment? Okay, so let's check the provisions of the treaty. So this is basically the diagram. So White Walkers paid dividends to Wildlings because Wildlings has investment in White Walker share. Okay, so let's check the provision of RP Norway tax treaty. So the term dividends as used in this article means income from shares or other rights, not being debt claims, okay, participating in profits, as well as income assimilated to income from shares by the taxation law of the state of which the company making the distribution is a resident. Okay, so that's what we mean by dividends. So parang effectively, it's just return from your investment in equity instrument. Okay, so this is the provision relating to the tax rate or taxability of the dividend. So dividends paid by a company which is a resident of a contracting state, so this is Philippines, to a resident of Norway may be taxed in Norway. Okay, however, such dividends may be taxed in the contracting state of which the company paying the dividends is a resident, so that's Philippines, according to the laws of that state, so according to Philippine laws. But if the recipient is the beneficial owner of the dividends, the tax surcharge shall not exceed. So these are the maximum rates. So effectively, it says here dividends are taxable in the Philippines, but the tax rate should not exceed these rates. So 15% of the gross amount of dividends if the beneficial owner is a company which controls directly or indirectly at least 10% of the voting power of the company paying the dividend. So which means that if the investor owns at least 10% of the domestic company, the rate will only be 15. Otherwise, the rate will be 25. Okay. So if you're going to look at our example, if there is no PE, since it is a wholly owned subsidiary of a foreign corporation, in this case, 15% tax will apply, right? Kasi at least 10 lang to. Wholly owned, it's almost 100%, right? So in this case, 25% rate here will not apply. Okay, but if it is only 5% ownership, then it will be 25% rate that will apply. Okay. So applying here the diagram. So this is basically how it will actually look like. So the investor is not a government. So we're going to ask whether there is a treaty. So there is a treaty. So since there is a treaty, we have to ask whether there is PE. Well, based on the problem, there is no PE. So based on Norway treaty, it's either 15 or 25. But in this case, since it's wholly owned subsidiary, 15% rate will apply. Okay, so this is how the tax will be calculated. So 1 million times 15%, it's 150. 1 million less 150, the net payment of the dividend will only be 850 because 150 will go to the BAR. Okay, so the next slide will show you a diagram on the cash flow. Okay, so White Walkers pays Wildlings 850 and then 150 will have to be paid to the BAR. With respect to the BAR forms, those are just similar. Okay, so I hope naintindihan nyo ito ha. So, di ba, it's somewhat similar to royalties, except that the diagram there actually introduces tax pairing, which is actually under the tax code. So that's not actually a complexity under the treaty, but that's a complexity under the tax code. Okay? So, sige, let's have a 5-minute break, and then after the break, we're going to resume. Okay? Yung mga sa dulo kasi parang paulit-ulit na lang din yun sa diagram. Okay? Sige. And then, so we'll have to resume around 10:55.
Thank you, Sir Aaron. All right, everybody, grab your water and your snacks and let's have a 5-minute break. Thank you so much.
Fuck you, any mom, any sister, any job, any broke ass car, and that shit you call art. Fuck you, any friends that I'll never see again. Everybody but your dog, you can all fuck off. I swear I meant to mean the best when it ended. Even tried to bite my tongue when you started shit. Now you're texting all my friends, asking questions. They never even liked you in the first place. Dated a girl that I hate for the attention. She only made it 2 days, what a connection. It's like you'd do anything for my affection. You're going all about it in the worst ways. I was into you, but I'm over it now. And I was trying to be nice, but nothing's getting through. So let me spell it out. A, B, C, D, E, F. You and your mom, and your sister, and your job, and your broke ass car, and that shit you call art. make it. Told everyone I'm a bitch, so I became it. Always had to put yourself above me. I was into you, but I'm over it now. And I was trying to be nice, but nothing's getting through, so let me spell it out. A, B, C, D, E, F. You and your mom and your sister and your job and your Craigslist couch and the way your voice sounds. Fuck you and your friends that I'll never see again. Everybody but your dog, you can all fuck off. Na 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 na. A, B, C, D, E, F. Na 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 na. A, B, C, D, E, F. You and your
Okay.
mom and your sister and your
Okay, so I think we're going to resume. Okay, so we're done already with business profits, royalties, dividends. Okay, so let's go next here to taxation of interest. Well, this is also similar to royalties and then dividends. Okay, so when we say here interest, this is income from debt claims. So in effect, the foreign investor probably here has investment in bonds, has actually a loan that's extended to a Philippine resident. So any return from that investment, that's actually considered interest. So it may also include income from government securities and bonds or debentures. Okay, now, if you're going to look at the OECD model, it says there that interest excludes penalty charges for late payments. Okay, so which means that what can we conclude here is that if there is an exclusion relating to penalty charges for late payment, let's say, for example, well, a Philippine entity here, okay, so let's say here we have non-resident foreign corporation, okay, and then we have the Philippine entity. So it's possible that this non-resident foreign corporation sells goods, and then there is an accounts payable here. And then this AP could be subject to penalties, okay, for late payment. So the penalties here may be considered interest if there is no exclusion. But if the treaty has an exclusion, then these penalties will not be considered interest, but instead, this will be considered business profits. Understand it? So penalties could either be business profits or interest. If the definition is silent, then that's considered interest. But if there is an exclusion, that's considered business profits. So what we've discussed earlier on business profits will actually be applicable. Okay, so I hope that's also clear. Okay, so nabaliktad yata ito. Okay, this is an example of a treaty wherein penalty charges are considered not interest, because if you're going to look at Singapore Treaty, it says there that penalty charges for late payment shall not be regarded as interest for purposes of this article. But if you're going to look at here, Russia, it does not have a provision on exclusion. So if it does not have any provision on exclusion, so in effect, the penalty charges will be considered interest. So this is an example of a treaty in which penalty charges are interest. This is an example of a treaty in which penalty charges are not considered interest, but instead, in this case, this will be considered business profits. Diba? Kasi penalty charges will not fall in any provision. Ibig sabihin, well, it will go in, you will apply there the catch-all provision on business profits. Okay? So I hope that you also somehow understand this. Okay, so this is another flow chart. Okay, this is somewhat simpler also, similar to royalties. Okay, so again, it depends on who the lender is. If the lender is a government, in any interest income here is tax exempt. But if the lender is non-government, the next question that you're going to ask here is whether the creditor is a resident of a treaty country or not a resident of a treaty country. If there is no tax treaty, then the general rule that we discussed earlier, okay, will actually apply. So it's either 20 or 25. But normally, if this is interest on foreign loan, it's 20% tax that will apply. But if there is a treaty, we're going to ask whether there is a PE. If there is PE, of course, it's still 20 or 25, similar to this. But if there is no PE, then you have to check the provision of the treaty. Normally, the treaty provides for a 10% or 15% tax rate, or sometimes it's actually tax exempt. So it depends. Okay, so this is the diagram relating to interest. Okay, so let's have an example here. And we have also incorporated penalty charges. So for this particular illustration, penalty charges are not considered interest. Okay, so Hodor Inc., a domestic corporation, had a loan of $500,000 US with 5% interest from Brand Corporation, a resident of Vietnam. So there is a treaty with Vietnam. So the loan was outstanding for the entire year. Interest was paid on December 31, 2021. So we assume the rate, the Forex rate is 1:50. And then penalty for late payment amounted to $1,000. So how much is the final tax liability and how much is the net payment? Okay, so there are two payments that we have here, the interest and then penalties. Okay, so this is the diagram on what transpired. Okay, so 5%, the brand extended the loan to Hodor, $500,000, and then there's payment of interest and then also penalty. Okay, let's look at RP Vietnam Tax Treaty. So this is a definition of interest. It says there means any income or income from debt claims of every kind, whether or not secured by mortgage, whether or not carrying a right to participate in the debtor's profits, and in particular, income from government securities and income from bonds or debentures, including premiums and prices attaching to such securities, bonds, or debentures, as well as income assimilated to income from money lent by the taxation laws of the state in which the income arises. So effectively, this is the definition of interest. Parang effect, it's actually cost of money, right? Okay, now it also says here that penalty charges for late payment shall not be regarded as interest, which means that the $1,000 that's penalties that's paid, that's not covered by interest. So we're going to apply there the provision of business profits. Okay, now with respect to the tax rate, it says here that interest may also be taxed in the contracting state in which it arises. So ibig sabihin, it will be taxed in the Philippines and according to the laws of the Philippines. But if the recipient is the beneficial owner of the interest, the tax so charged shall not exceed 15%. So the cap here is 15%. Okay, the competent authorities of the contracting state shall by mutual agreement settle the mode of application of this limitation. Okay, so cap again is 15. Okay, so let's check what tax rate will apply. So in this case, the lender is not a government. We're going to check whether there's a treaty. So there is a treaty. Is there a PE? There's no PE. So since there is no PE, 15% rate will apply. Because if you're going to look at it, there's only one rate that's provided here, right? Okay, so if that's the case, it's 15% final tax. Okay, so if this is the case relating to interest, we're going to apply here 15% tax. So $500,000 loan multiplied by 50 Forex rate times 5% rate. So the interest is 1,250 times 15%. So the final tax here is 187,500. So the total interest is 1,250. We deduct here 187,500 because this will have to be paid to the BAR. The net payment of the interest here will be 1,062,500. So this is that's basically relating to interest. Okay, let's look at taxation of penalty. So this will apply to penalties. Okay. So again, it depends on whether there is a PE. Okay. So this is just a definition of, this is just a provision of business profits. But anyway, the chart that we discussed earlier will still apply. So effectively, penalty charges will be taxed in the Philippines if Vietnam entity has a PE in the Philippines, but there is no PE, right? So since there is no PE, it will be tax exempt. Okay, so penalties will not be subject to income tax. Okay, so if that's the case, full payment of 50,000 will have to be made. So that's 1,000 times 50, it's 50,000 penalties. So net payment is 50, there is no deduction because there is no PE. Okay, so to summarize, this is the diagram, the cash flow diagram. So Hodor will have to pay interest net of 1,062,500 plus 50,000 penalties to Brand, and then the final tax of 15%, equivalent to 187,500, that will have to be paid to the BIR. Okay, so I hope that this is actually clear. Okay, nasusundan nyo pa rin, ha? I know na medyo heavy siguro ito. Okay, let's go to the next illustration. This illustration assumes that penalty charges are considered interest. Okay, similar situation, but we're going to assume that the lender is a resident of Russia. Okay, so similar requirements. So let's look at, so this is the diagram. So let's look at RP Russia. So this is the definition of RP Russia. So if you're going to look at it, it's somewhat similar to Vietnam, but there is no exclusion. So if there is no exclusion, then these penalty charges may be considered interest, right? So let's look at the tax rate that will apply. The tax rate under RP Russia is also 15%. Okay, so if that's the case, this will be the flow chart. So there is treaty with Russia, but there is no PE. That's why 15% tax will apply. Okay, so if this is the case, this is how the tax will have to be calculated. So in effect, aside from the interest of 1 to 50, we're going to include here penalty charges. So total amount will be 1.3. Okay, 1.3 payments including penalties multiplied by 15%. So the final tax will be 195. So the net payment will only be 1105 because from 1.3 we have to deduct 195,500. And again, there is no permanent establishment. Okay, because if there is PE, of course, 20% tax will apply. Okay, so this is the diagram. So 1105 here, that's actually net for both penalty charges and interest. So 195 will be paid to the BIR. Okay, so that is taxation of interest. Okay, so sana naintindihan nyo, ha? Okay, kasi pagdating na sa capital gains, medyo mag-iiba na yun na konti. Okay, so we have discussed business profits, royalties, dividends, and then interest. So if you're going to look at the interpretation of the treaty or application of the treaty with respect to these income items, more or less there is or there are similarities. Okay, so again, if there is PE, disregard the tax treaty. If there is no PE, apply the provisions of the treaty. Okay, so okay, let's go next here to capital gains. So when we say our capital gains, okay, our focus relating to capital gains here will be investment in shares. Okay, because generally, if we're talking about capital gains, syempre, foreign corporations naman cannot own or will not be owning here real property, di ba? Kasi they are foreign, and then they are not allowed to own land with respect to building. They cannot also own a building because they are situated outside, right? Okay, so that's why the focus of our discussion here will be investment in shares. So if they have investment in domestic shares, generally, di ba, they are taxed at 15% CGT, right? On the disposal of domestic shares. Now, when we say here capital gains, this actually arose from alienation of immovable property. So if you are selling immovable property, if you have, let's say, for example, if you own immovables here in the Philippines, that's considered capital gain. Alienation of PE or its movable property. So let's say if they have Philippine branch and then they're going to sell that Philippine branch, that's considered also capital gain. Alienation of shares in a company holding immovable property. So this one, this is what you call real property interest. So we're going to discuss this later. Okay, sometimes this is not contained in the treaty. Sometimes there is a provision in the treaty. So if you're going to look at it, in effect, the investee company here owns immovable property. Okay, so parang effectively, we have here a non-resident foreign corporation. Okay, it has investment in PH. So there is investment in shares. Okay, and then this PH entity owns immovable property or real property. Okay, now but there is a limitation here. Kasi syempre, we cannot actually avoid it that this PH entity may be owning real property. But normally the limit that's applicable here is 50% of total assets. Okay. So in effect, if this owns more than 50% real properties in comparison to its total assets, well, the shares here will be considered alienation of shares in a company holding immovable property. But if it is less than 50%, it's not actually immovable. It will not be constituted as shares in a company holding immovable property. But again, as I mentioned, merong treaty na merong ganito, merong treaty na wala ito. Okay? So we're going to discuss that also. Okay. So this is what we mean by real property interest. Okay, it's actually similar to my previous illustration. Okay, because effectively what happened here when we say real property interest, the investee company, this is the investee company, owns real properties, okay, which are more than 50% of its total assets. Okay, so the seller here has investment in Philippine entity shares. So this is a foreign corporation, huh? So seller, this is non-resident foreign corporation. It has investment in Philippine entity shares. Okay, this investment will be considered, well, alienation of shares in Philippine entity holding immovable property. Okay, that will be considered capital gains that will be taxable. Okay, when the seller sells to the buyer. Okay, so let's say these Philippine shares were sold to the buyer, and then of course the buyer will have to pay the seller. And then after the sale, the buyer will already be owning this Philippine entity. Okay, so again, this will be considered, the transfer of the shares here will be considered alienation of shares in a Philippine entity. Okay, that's basically holding immovable property. If the real properties if the real properties that it owns are actually more than 50% of total assets. Do you understand it? Pero kapag less than 50% yan, then that will not be considered capital gains that will be taxable. Okay? So again, it depends on the treaty, ha? Merong treaty na this is not relevant. There are treaties in which this will be relevant. Okay, so let's say, for example, France. So France treaty, well, actually says that alienation of immovable property, okay, in a company that holds real properties, that's considered capital gains that will be taxable. Okay, let's go over here the provision. Gains from alienation of immovable property as defined in paragraph 2 or article 6 or from alienation of shares. Ito yung relevant provision. Alienation of shares or comparable interest in a real property cooperative or in a company, the assets of which consist principally immovable property may be taxed in the contracting state in which the property is situated. So basically, this is Philippines. Okay? So ito na yung sinasabi ko. So that's why in this case, if you're going to look at this particular situation, the capital gain that the seller here derives from the alienation of Philippine entity shares will be taxable in the Philippines because this Philippine entity owns more than 50% real properties, okay, in comparison with its total assets. Do you understand it? Okay, so ito yon. Now, how about a tax treaty in which it does not contain real property interest provision? So gains from alienation of immovable property may be taxed in the contracting state in which the immovable property is situated. So in this case, it does not contain a provision relating to shares. So if that's the case, capital gains here that will be taxable in the Philippines will only be limited, okay, to, well, real properties talaga, immovable properties. Okay, capital gains do not include disposal of shares. So if that is the case, even if this Philippine entity owns, okay, more than 50% real properties, okay, of its total assets, well, the disposal of the shares will not be taxable in the Philippines if you're going to apply Brazil treaty. But if you're going to apply France treaty, that will be taxable. Okay, so I hope na intindihan nyo, ha? Okay, so effectively, this is the summary of the tax implication of the disposal of the shares. So does investment pertain to a domestic shares? Okay, if these are investment in foreign corporations, of course, that's not taxable in the Philippines because that's not considered derived from sources within the Philippines, right? Okay, so may exception din yan sa tax code, di ba? Yung 85%. Okay, but in this case, we assume that this foreign corporation does not have, well, investment in the Philippines. Okay, so effectively, if the shares pertain to the investment in foreign corporation, that is actually tax exempt. Okay, of course, subject to exception. But if these are investment in domestic shares, so that's where you're going to ask whether there is a treaty. If there is no treaty, automatically 15% CGT will apply. So as mentioned earlier, this will start April 11, 2021, which is the effectivity of the create. Okay. Now, if there is a treaty, we have to check whether there is a real property interest provision. If there is no real property interest provision, just like Brazil, the disposal of the shares will be tax exempt. So example nito kanina, it's Brazil, right? But if there is real property interest, so this one example that we have earlier is France. Okay, if there is real property interest provision, similar to the Treaty of France, well, if the investing company, if the Philippine company owns real properties which are more than 50% of its total assets, then it will be subject to 15% CGT. Okay, but if the real property ownership is less than 50%, then it will still be tax exempt. Okay, so I hope nasusundan ito, ha? Okay, so this is how you're going to apply wealth taxation of capital gains. Okay, let's have an example. So without real property interest provision. So on September 1, 2021, John Snow Corporation, a non-resident foreign corporation, okay, sold 10,000 shares of King's Landing Philippines Corporation, a domestic corporation, for 1,000 per share. So said shares were acquired for 800 per share on May 1, 2020. So it was sold for 1,000. Okay, it was acquired for 800. So effectively, there is a gain of 200, right? So this is your capital gain. So our issue here is this taxable. Okay, John Snow is a resident of Sweden. So there is treaty with Sweden. So King's Landing's total assets amounted to 30 million, in which 17 million pertains to real property. So this is already more than 50%. So if there is real property interest provision, then of course this will be taxable. But it says here without real property interest. Okay, so will the gain here of 200 per share be taxable? So will there be CGT? Sige, let's check. Okay, so this is basically what happened. So John Snow has investment in King's Landing, 10,000 shares. Okay, these were sold to the buyer for 1,000 per share. So after the sale, the buyer owns King's Landing, okay, by virtue of the 10,000 shares that it actually purchased. Okay, so let's look at the treaty provision. So this is Sweden. So gains derived by a resident of a contracting state from alienation of immovable property may be taxed in the Philippines. Okay, so immovable, it's only limited to immovable. It does not include shares. So if that is the case, this will be the disposal of the shares here will be tax exempt, even if the total assets, okay, comprise of real properties that are more than 50%. So in this case, this is not relevant. So the tax here will be exempt, right? So domestic shares, yes. Is there a treaty? Yes. Is there a real property interest provision? No. So that's why it is exempt. Okay, so no capital gains tax. Okay, now let's look at another situation. So instead of Sweden, we assume that this is United States. Again, this is more than 50% real properties. So will this be subject to CGT? Okay, so it's just similar. So the real property interest is 56.67%. So which means that this is alienation of shares, okay, in a company that holds immovable properties because this is greater than 50%. Okay, so let's look at the provision of RP United States. Okay. Okay, well, although there is this provision, I think what is more relevant here is the resolution on the ratification. Okay, so merong ratification kasi yung US that there is actually a resolution. It says here that reservation that notwithstanding the provisions of Article 14, so ito yon, Article 14, okay, relating to capital gains, both the United States and the Philippines may tax gain from disposition of an interest in a corporation if its assets consist principally of real property interests located in that country. So which means that if King's Landing owns more than 50% real properties, then that will have to be taxed in the Philippines. Likewise, both countries may tax gain from the disposition of an interest in a partnership. So this is partnership. Okay, the real property interest is to have the meaning it has under the law of the country in which the underlying property is located. So which means that when we say here real property interest, we have to apply the Philippine tax law because that is what's provided for under the tax treaty. Okay. So if that's the case, so this is how the tax will be, or this will be the tax implication. So again, there is a treaty. Is there a real property interest provision? Yes. So is there real property interest? Yes. So in this case, the disposal of the shares will be subject to 15% CGT. Okay. So 10 million less 8 million. So that's 2 million. So effectively, this is 1,000 per share, 800 per share. So that's 200 per share times number of shares. So times 10,000. So this will be 2 million capital gains. So that will be taxable at 15%. So the CGT will be 300,000. Okay. So this is how your real property interest is calculated. So real property, 17 million. Total assets, 30 million. So real property interest is 56.67%. Okay. So I hope that you somehow understand this. Okay. So that is taxation of capital gains. Okay. So this is actually the last part. Okay. Dependent personal services. So this is already dealing with individuals. Okay. So individuals na to ha. So when we say here dependent, ibig sabihin there is an employment. So this individual is actually employed. Normally, this individual is employed by a foreign corporation. So effectively, we have this non-resident foreign corporation. It has an employee. Okay, so employee niya to. So it pays salaries. Okay, but this employee is here in the Philippines. Okay, so will the salary here that this employee received from this foreign corporation be taxable in the Philippines? Okay, remember, di ba, alien ito. So this is an alien. So for assuming it's non-resident alien, okay, whether engaged or not engaged, they are taxable on income within. Okay, so generally, this employee is taxable in the Philippines, okay, if the services are rendered within. But if there is a treaty, the salaries that he or she receives from foreign corporation, that can also be tax exempt. Okay, so with respect to dependent personal services, the definition here is that there is unemployment, and then there are salaries, wages, and other remunerations that are being paid to this individual. Okay, so issue, will this be taxable? Okay, so these are the exclusion. it excludes pension. So hindi kasama yung pension. Now, normally, the treaty provides for exemption of this salaries, wages, and remuneration. So normally, the treaty contains this provision. So parang effectively, in order for the salaries, remuneration to be tax exempt, all of this will have to be met. So employees stay in the Philippines does not exceed 183 days. And the payment by non-resident employer. So ibig sabihin, the compensation is paid directly by foreign employer. And then it's not borne by PE of non-resident employer in the Philippines. So which means that if the foreign corporation has a Philippine branch, has a PE, well, the payment is not being made by that Philippine branch. Okay, do you understand it? Okay, so all of this will have to be met. If one is not met, that's already taxable. Okay, so let's have a flow chart. So our services rendered within the Philippines. So since we are talking of aliens, if rendered outside, it's tax exempt. If rendered within, we're going to check whether there is treaty. If there is no treaty, this is tax code. Okay, so tax code ito, di ba, that we discussed earlier. So if it is tax code, we're going to ask whether it's non-resident alien engaged. If it is engaged, graduated rate of 0 to 35%. But if it is not engaged, it's 25. Okay, but if there is a treaty, okay, you have to ask whether the requirements for tax exemption under the treaty are met. If the requirements for tax exemption under the treaty are met, then it will be tax exempt. But if the requirements are not met, then it will be taxable depending on whether it's engaged or not engaged. So this one, this is engaged. This one, this is not engaged. So basically, this is already tax code. Okay. So I hope that you still follow this diagram. Okay. So let's have an example. Mr. Ned Stark was employed by Winterfell Corporation. So during 2021, he was assigned to render consultancy services to Dragonstone Philippines Corporation, a Philippine subsidiary of Winterfell. Mr. Ned Stark and Winterfell Corporation are residents of Norway. So in this case, we have to apply the treaty with Norway. So Mr. Ned Stark was in the Philippines for 7 months. Okay, so 7 times 3, so that's already more than 183, right? But again, we'll have to check the provision of Norway Treaty. So Mr. Ned Stark received compensation of 500,000 directly from Winterfell. Okay, so it's not paid by a PE. So it's directly paid by a foreign corporation. So how much is the income tax of Ned Stark? Okay, so let's check. So this is basically what happened. So Winterfell pays compensation to Ned Stark. So this is Norway. Okay, and Norway and Winterfell here, and Dragonstone here is a subsidiary of Winterfell. So Ned Stark renders consultancy services to Dragonstone. So in effect, diba, generally, the compensation here that Ned Stark derives will be taxable because Ned Stark is rendering consultancy services in the Philippines, right? Okay, so let's check. Wala, may kulang pala to. Okay. So assuming, dapat may provision dito ng treaty. Okay, let's just stick here to the general, to this one. Okay, so assuming this is also the same provision under the Norway Treaty, did he stay in the Philippines for less than or equal to 183 days? Hindi, di ba? This is not met because he was here for 7 months, right? 7 times 3 is around 200 plus days, right? So that already breaches this 183-day threshold. So this is no longer met. Okay, but is the payment made by non-resident employer? Yes, so this is met. The payment is not borne by PE. It doesn't say that it's shouldered by a PE, right? So which means that this is also met. Okay, so ibig sabihin, only 2 requirements are met, okay, over the 3 requirements. So if that is the case, going back there to the flow chart, requirements are not met. That's why it's taxable. Okay. Is he non-resident alien engaged in your business? Yes, because, di ba, may threshold din yun. Ano nga ba threshold? 183 or 180 days. Di ba? Kapag non-resident engaged ka, you breach the threshold. So it's 180 or 183. Since it's already 200, so which means that he will be considered non-resident alien engaged. That's why it will be subject to graduated rate. Right? Okay? So non-resident alien engaged, so that will be subject to graduated income tax rate, not the 25% tax. Okay, so if that's the case, his compensation will be taxable in the Philippines. So he will be subject to graduated rate. So consultancy fees here, 500,000, this will be entirely taxable. So we're using the graduated income tax rate, di ba dito yon? So 500,000, that will actually fall in this particular graduation. So 30,000 for the first 400,000. In excess of that 400,000, that will be taxed at 25%. So that's why, 500 less 400, so that's 100 multiplied by 25%. So the tax here on the tax here on the excess of 100,000 will be 25,000 plus 30,000. So the tax due is 55,000. So this is the tax that will have to be paid by Mr. Stark. Okay. So requirements for exemption are not actually met. So I hope that you follow. Okay. Sige, let's have another example. So it's similar. Okay, still Norway. Pero he's here only for 3 months. Okay, so 3 months. So that's only around 90 days, right? So, okay, so going back to the... Ito pala yung sa Norway. Okay. So again, it's 90 days. So we're going to evaluate. Okay. So how much is this income tax? Okay, so it's still the same. So if you're going to look at Norway, so the first one there is 183 days. So the recipient is present in the Philippines for a period or periods not exceeding 183 days. Diba? In the first situation, it's more than 183, right? So that's why this is not met. In the second situation, it's less than 183 days. So ibig sabihin, second situation, this is met. Okay. Now, second requirement, remuneration is paid by or on behalf of an employer who is a resident of the state of which the recipient is a resident. So this is Norway, and whose business activities do not wholly or mainly consist of hiring out of labor. So this is also met because the compensation is paid directly by Norwegian entity. And then the remuneration is not reasonably connected with the activities of a PE or fixed base in the Philippines. So this is also met because it doesn't say that it's actually being borne by a Philippine PE. So if this is the case, all requirements are met. So which means that it will be tax exempt. Okay, why is tax exempt? Because it says here that, okay, let's read the first paragraph. Subject to the provisions of this article, salaries, wages, and other similar remuneration by a resident of a contracting state, so this is Norway, in respect of an employment shall be taxable only in Norway, unless the employment is exercised in the Philippines. So if the employment is so exercised, such remuneration is derived therefrom may be taxed in the Philippines. But this is subject to number 2. So notwithstanding the provisions of paragraph 1, remuneration received by a resident of a contracting state, so this is Norway, in respect of an employment exercised in the Philippines shall only be taxable in Norway if all these requirements are met. Diba? All these requirements are met, which means that it should only be taxable in Norway. It will not be taxed in the Philippines. So if this is the case, it will be tax exempt because all requirements are met. So Mr. Stark will not be paying any Philippine income tax. Okay? So all payments will have to be made to Stark, no withholding tax. Okay? So that actually covers dependent personal services. So actually, this is the last part na, okay? Before we go into some requirements. Okay, so let's have the polling question. As stipulated in a double taxation agreement, which of the following may be exempt from income tax in one contracting state? Okay, what do you think? So it actually applies what we discussed previously. Okay. O walang sumasagot ah. Nandiyan pa ba kayo? Okay. So I hope nakikinig kayo ha. At saka naintindihan yung na-discuss natin.
All right, we still got 13%, 15% was participating in the poll. Everybody.
Okay, I think basta yung sa series na to, this is actually the most technical one, the first topic. In the subsequent topics, well, it's actually quite simpler as compared to this. Yung etong topic kasi na to, this is quite analytical. And then, well, of course, this requires that you have somehow understanding of the basic taxation because we are already incorporating here the impact of the tax treaty. Wala lang sumasagot, 30 lang sumagot. Nasaan na yung iba? Ano yan, na-bored na kayo? Hindi na talaga gumagalaw. Nandyan pa ba kayo? O isa lang na dagdag yata.
All right, try nating abutin to 40%, guys. Okay, we need 2% more.
Gising pa kayo ba dyan? I know that this is actually quite difficult, but I hope that you somehow understand it. Well, I don't actually expect that you'll be able to understand what we have actually discussed.
Everything.
All right, I'm gonna end the poll now, sir. I think we reached 40% na.
Okay, so answer, of course, here. Answer here, of course, is business profits. Diba? If you're going to look at dividends, interest, and royalties, they are taxable both in the foreign country and in the Philippines generally. Okay, but with respect to business profits, it can be tax exempt in the Philippines. Diba? Okay, so that's why answer here is business profits. Okay, now I'm going to discuss next. So this, I'm already with respect to the summary of the requirements. This will just be quick. Okay, now the requirements now, okay, under the law or rather under the rules is that if you're going to avail of the treaty benefits, so ibig sabihin, if there is no PE, you're going to apply the tax treaty rate, right? Or tax treaty rules. If you're going to apply the tax treaty rules, well, the rules require that you have to apply for tax treaty relief, okay? So basically, this is under a new issuance of the BAR, which is effective sometime in April this year. Okay, so the prior kasi to April, well, there's a previous requirement, but it's still application for tax treaty relief. Okay, so basically, under the current rules, with respect to dividends, royalties, and then interest previously, you are required to submit the court form, the certificate of residence for tax treaty relief. But under the new rules, effective this April, well, you are already required to submit TTRA, the tax treaty relief application or request for confirmation. But with respect to other profits or other income, so let's say, for example, business profits, capital gains, okay, dependent personal services, you're going to apply for TTRA or request for confirmation. Ito kasi, it's the same as the old rule. So same as old. Okay, but with respect to interest, dividends, and royalties previously, it's court right now. It's also request for confirmation or TTRA. So parang effectively, the rules, the requirements, well, are already the same. Okay. Now, what do you mean by tax treaty relief application, or when do you apply for tax treaty relief application? Okay, and where? Now, basically, when we say here tax treaty relief application, you are actually applying for confirmation with the BIR that you are qualified under the provisions of the treaty. That's why you are enjoying exemption, or you are applying the lower tax rate under the treaty. Okay, so basically, when we are applying here for tax treaty relief application, we have to secure from the non-resident. Okay, so normally this is non-resident foreign corporation. Okay, BR form 0901. So this is an application form which should have to be filled up by the non-resident. And then aside from that, you have to secure tax residency certificate of this non-resident. So this tax residency will actually indicate, well, the country of residence of this non-resident. Okay, so again, this is applicable if there is a treaty between the Philippines and the foreign country. You're not going to apply tax relief application if the non-resident is not a resident of a treaty country, or you are no longer qualified under the tax treaty. So this is only applicable if you're qualified under the tax treaty. Okay, so basically, these forms will have to be submitted to the withholding agent. Sino ba yung withholding agent? So this is the Philippine resident. Okay? And then the Philippine resident will have to apply for tax relief application or request for confirmation with the International Tax Affairs Division of the BIR. And then the BIR will evaluate it. After evaluating it, assuming you are qualified for exemption or benefit, they're going to issue certificate of entitlement to tax treaty benefit. So, or that is the COE. If the BIR actually sees that you are not qualified, then they're going to issue a denial. Okay, so that's basically the process for application of tax treaty relief or request for confirmation. Okay, so basically, this is the implication if you comply with the requirements. So under the law, or under the rules rather, okay, if you properly submit these forms and apply for request for confirmation, and then you comply with the provisions of the treaty, okay, you are considered compliant. If that's the case, the BIR will just confirm that you are entitled to the benefits under the treaty. But if you are not compliant, ibig sabihin, you did not submit TTRA, you did not actually request for file request for confirmation with the BIR, you are not allowed, okay, to avail of the tax treaty benefit. So in that case, regular rates will apply effectively. It means that you're going to apply the tax code. So even if there is a treaty, if you fail to apply for TTRA or request for confirmation, well, the BIR is saying the tax code rate will apply. Okay? So parang it somehow deviates from the requirement or from the Supreme Court decision on Deutsche Bank. Okay, I'm going to somehow discuss this in a while. Okay? Kasi ito yung sinasabi ni BIR. But that may not be consistent with the Supreme Court decision. Okay, but although the BIR is justifying that this is still compliant with the requirements of the Supreme Court. Okay, so effectively, the tax treaty rate or benefits, okay, will be applied by the withholding agent, diba? So let's say, for example, you're paying interest and then there is no PE. Okay, so you're applying the tax treaty rate. So if you're going to apply the tax treaty rate of, let's say, for example, 15% on interest, the withholding agent here is required to file for TTRA or request for confirmation with the ITAD. Pero there are cases in which this withholding agent is conservative. So sabi niya, okay, conservative ako, wala tayong TTRA na final. Instead of withholding 15%, I'm going to withhold 20%. Okay, so 20% final tax, this is tax code. So if that is applied, so ibig sabihin, it's already regular rate under the tax code, but still the non-resident wants to dispute the 20% rate that's applied. What will the non-resident do here? So the non-resident instead will be filing a TTRA or request for confirmation with the BIR. Do you understand it? So I hope that you got this slide, ha? So ibig sabihin, if the withholding agent did not apply the tax treaty rate, although it is entitled to the tax treaty rate, okay, So it will be the non-resident who's going to file for TTRA or request for confirmation with the BAR. Okay? In order to confirm that instead of the 20%, 15% rate pala yung applicable. Diba? Okay. Now, what will happen here if the BAR confirms or denies the application? If the BAR confirms the application of the treaty, okay, the benefits from the treaty, and then you apply there the proper date, then of course, there's nothing to do on the part of the taxpayer. But, assuming the BIR confirms, tapos sabi niya, ay nag-over-withhold ka ng tax. So instead of, let's say, 10%, you applied 15%, so there is an over-withholding of 5%. So what will the taxpayer do? File for refund. Okay, pero syempre, from a practical standpoint, it's actually difficult to claim for refund from our Philippine government. Unlike if you're claiming for refund in developed countries like United States, Singapore, hindi ka na nga mag-file for as long as negative yung nilagay mo sa return, automatically the government will actually refund your tax. But in the Philippine setting, even if you indicated in your BIR form that you have negative tax payment, well, the government will not actually refund you that negative tax payment. You have to file for refund with the BIR, and then you have really to exert effort to get that money from the government. And then normally the BIR does not act on the claim for refund. What we're going to do there is to elevate or file a petition for review with the Court of Tax Appeals. Okay. Now, what will happen if the BIR denies your claim for the availment of the benefit under the treaty? Let's say, for example, you use the tax city rate of 15%. Sabi ni BIR, you are not qualified for availing 15%. So dapat sabi niya 25% na tax code. So if that's the case, there is a deficiency tax of 10%. So what will happen? You will be liable to deficiency tax plus penalties for under withholding. Okay? So it's really important that if you're applying for TTRA or request for confirmation, you have to ensure that you are qualified and entitled to the benefits under the treaty. Otherwise, the BIR will actually assess you deficiency taxes plus penalties. Okay? Now, another important thing here that you have to note with respect to application for tax treaty relief is whether the contract that you have with the foreign corporation is long-term or short-term. It will affect the frequency for application of tax treaty relief. If it is just short-term, one-time application will be sufficient. But if it is long-term, well, there will be annual application in order to update the tax residency certificate. Kasi pwedeng nag-iba yung residence niya, di ba? Nag-iba yung country, di ba? So it will actually affect the applicable tax rate that will have to be applied. Okay? So when we say here long-term, it may be applicable to interests, okay, to royalties, di ba? That are more than 1 year contract, 2 years, 3 years, 4 years, or 5 years. Okay? Now, when should TTRA or request for confirmation be filed? It will be filed 4th month following the end of the taxable year. So, ibig sabihin, for 2021, tax treaty benefits. So, let's say, for example, you're applying here the tax treaty benefits for interest, dividends, and royalties and business profits for 2021. This will have to be applied. You're going to apply for TTRA next year. So, the deadline there will be April 30, 2022. So which means that you already applied the benefits this year, but you're going to apply for request for confirmation or TTRA pa next year, April 30, 2022. So that's the deadline set by the BIR. Okay? Now, this is the case that I'm actually telling you. Kasi ito yung requirement ni BIR. But if you're going to look at here, the Deutsche Bank case, this was actually decided in 2013. Okay? Based on the case, sabi dito ng Supreme Court, well, dapat even if you do not have tax treaty relief application, you are still entitled to the tax treaty benefits provided that you comply with the provisions of the treaty. Okay, what happened here in the case is that Deutsche Bank, okay, Philippine branch remits branch profits to its head office. Okay, so this is actually under the Treaty of UK. Branch profits, branch profit remittances here are considered dividends under the treaty with UK. Okay, so it remits branch profits to its head office. It subjected this to 15% final tax. Okay, but if you're going to look at the treaty with the United Kingdom, this can be taxed at 10%. So ibig sabihin, Deutsche Bank remitted higher tax. That's why it claimed for refund from the BAR. Do you understand it? So basically, the 15% branch profit remittance tax here, this is under the tax code. But if you're going to apply the tax treaty, it should be 10%. So that's why there is overpayment of 5%. So Deutsche Bank Philippine branch claimed for refund with the BAR. So I think Deutsche Bank also applied the 15% tax because it did not actually apply for TTRA. Okay? So wala kasing TTRA. Pero siguro tinaray niya, sige, I'm going to raise this as an issue with the court and then check whether even if there's no TTRA, I will still be able to avail of the 10% tax. Okay, so basically the issue here is does failure to comply with TTRA requirement deprive the taxpayer of tax treaty benefits. Okay, the court actually did not agree with the BAR's decision. Okay, so basically the BAR is the court is saying that the tax treaty should prevail over the revenue memorandum order requiring tax treaty relief before you can actually avail the incentives under the tax treaty. Okay? So sabi ng court here, non-compliance will have negative implication on international relations because it's already a treaty. So why is it that the BIR will still impose additional requirements? So this will actually discourage foreign investors. Remember the objectives of tax treaty earlier that we've discussed, right? That's basically to, well, simplify, of course, the taxation and then avoid double taxation, right? And then the court is saying that this tax treaty relief application requirement is just administrative procedure. So non-compliance should not deprive the taxpayer from availing tax treaty benefits. So ibig sabihin, if the taxpayer here failed to comply, well, it should still be entitled to tax treaty benefits. Probably the maximum that the BIR can do there is just impose administrative penalties. Okay, so that's basically the Supreme Court decision. So parang ibig sabihin, ngayon may issue na naman tayo kasi meron namang additional requirements si BIR that says that if you fail to comply with application for tax treaty relief, you are not entitled to tax treaty benefits. So that's not consistent, again, with the Supreme Court decision. But again, the BIR is trying to justify that it's still in accordance with the court decision. But we'll see later on if there will be a case that will be brought against the taxpayer, whether the court will still rule similar to what was ruled here in Deutsche Bank case. Okay, so but of course, currently what the taxpayers are doing is that in order to be conservative, they just apply for tax treaty relief with the BIR or request for confirmation to avoid an issue later on. Kasi normally, when BIR examines the books, they will actually look for tax treaty relief application, they will actually look for request for confirmation, and then, di ba, mayroon yung certificate of entitlement that the BIR will actually issue. Okay, so yun, hahanapin yun ni BIR during examination. So to avoid issues during examination, it's conservative to comply with the tax treaty relief application requirements of the BIR. Okay, it's really difficult to explain with the BIR. Di ba? So that's, kasi kapag titingnan mo yung examination, BIR examination sa atin, it's actually burdensome. Okay? So that's why taxpayers are actually sometimes hesitant to argue with the BIR. So it's really difficult. Okay? Yung iba nga resorts to under the table, di ba? But of course, as future taxpayers, as future tax consultants, di ba? As future CPAs, you should avoid, okay? Well, engaging in those illegal activities. Illegal yung mga under the table na yun, di ba? So dapat hindi nyo gagawin yun in the future, right? So in our practice also, okay, we do not actually tolerate, well, doing those transactions, okay? So I am connected with SG, we were actually strict with respect to that, okay? And then, of course, if I have clients, if I encounter clients who are actually doing that, I'm actually telling them, okay, na as much as possible, do not actually do it. So instead of paying under the table, well, just we can actually assist them, okay, in making the transactions legitimate. So instead of paying those under the table, just pay us our professional fees. And then the professional fees probably that they're going to pay us, it's actually lesser than, well, the amount that they're actually paying to, that they're actually paying illegally na under the table. Okay? Diba? So effectively, ano pa, it's above board, and then you're actually doing all transactions the right way. Okay? So my messaging here is that, well, avoid doing illegal activities later on if you already become CPAs, if you're actually practicing. So pwede naman you're already practicing right now, di ba? You're helping your parents, or probably you're helping other businesses. Well, do not tolerate businesses to engage in these illegal activities. Okay, so that's also helping the government, right? And then that's also educating taxpayers to actually pay the correct taxes. Okay, so let's have the polling question here. So I think it's the last one. So true or false? So each request for confirmation and TTRA is to be filed with the International Tax Affairs Division of the BAR. Second, each request for confirmation and TTRA is to be filed with other BAR office. Okay. Which statement is true here? Hindi gumagalaw ah. Mag-participate na kayo, last na to eh.
All right, I'm seeing 13%, 15%. Let's keep on voting, guys. Let's try reaching again 30 or 40. Okay, when we reach 40. We're on 36% already, 37. Last 2%, and I'm gonna end this poll. All right, I'm gonna end this poll right now, sir.
Okay. So what will be the answer here? So we've actually discussed this, right? So what do you think is the answer? Answer, of course, is only the first statement is true. So basically, di ba parehong statement ito, right? Except that in the first statement, it says ITAD. In the second statement, it says other BAR office. So as discussed earlier, the request for confirmation and TTRA should be filed with the ITAD of the BAR. So that's why only first statement is true. Okay, so that actually covers my discussion for this morning. Okay, so if you have questions, okay, so I'm going to turn you over to the host, and then if there are questions, so probably what should be done here?
All right. Thank you so much, sir, for that talk. And good morning once again. Here's a Zoom. I'm taking over ng Dea because she got disconnected due to power interruption. So, sir, thank you once again for that very insightful discussion in the field of taxation. And I'm sure that most of our audience here who are currently interested in venturing in this field in the future are now really considering doing so because of your comprehensive talk. And so, of course, before we proceed to the questions, let me extend our appreciation for granting our invitation for today's event. Allow me to award this certificate to Sir Aaron. The certificate reads, University of the Philippines Visayas, College of Management, Junior Philippine Institute of Accountants, Iloilo City, Iloilo. This certificate of appreciation is presented to Mr. Aaron C. Escartin, CPA, for sharing your time and expertise as a guest speaker in the UPV Tax Lecture Series, given this 11th day of December 2021. Signed, Dea Camille S. Villanueva, Vice President for External Affairs of UPV JPA, and Ms. Earl Cristina Ilusorio, Advisor of UPV JPA. Again, Sir Aaron, thank you very much for making time and helping our aspirant tax partners.
Okay,
Now,
thank you.
we request everyone, if your bandwidth allows, please turn on your cameras for a photo op with our speaker. Nico, just please give the cues whenever you are ready. Thank you.
Hello, everyone. please turn on your cams if you can para maka-photo up ta. Okay, amo lang na. Okay, we'll take the screenshots. 1, 2, 3, smile. Okay, thank you.
All right. Thank you, Nico. Thank you, everyone. And thank you once again, Sir Aaron. Unfortunately, since our time is very limited and also we don't want to stretch it too much and over time since we understand maybe a lot of us have prior commitments for the succeeding hours. So if ever you have questions for Sir Escar team, you may send in your questions here in the Zoom chat, or you can email or message any UPV JPA officer so that we can forward your questions or clarifications to Sir Aaron right after this event. And then we'll get back to you via emails after Sir Aaron have answered your questions. All right? Now, before we officially close the space by singing the UP Naming Mahal, let us all welcome Mr. Edsel Francis T. Lima, CPA, a UPV BSA alumnus and currently a Senior Tax Associate at XGV & Co. Let us give him a warm virtual round of applause, please.
Thank you very much, Nina, and also to Dea, who got disconnected, no? First of all, thank you. Thank you, Sir Ace, and thank you sa JP, CMSC, Jess, Tycoons, Magnates. Ayun. Thank you for working or collaborating with us to make this morning's session successful. And we are looking forward for the next two sessions, which is actually less technical than the first session. So thank you as well to Dean Tope, Sir Kim, Sir Lawrence, Ma'am Earl. Thank you for coordinating with us and allowing this lecture series to happen. And ayun nga, as what Sir Ace mentioned, this session is a very technical one. And I know that it's difficult to understand or to grasp, but it's easier to appreciate when you're already in practice, no? So we're looking forward to have future tax consultants, tax practitioners from this the participants in this session. And I hope that if you're interested to practice tax in the future, feel free to reach out to us, since to Sir Ace, to us, to the team, and to also to the SGV team if you want. No? So we have also accepted some interns from the previous na mga discussions with JPIA, and we are looking forward to that as well if you want to join us. Ayun, tax is very dynamic and very challenging. So yun, if you want the challenge, if you want the changes, no? So if you want to remain updated, you can also consider joining the tax practice. And even if you want to be future lawyers, you know, or if you want to practice law, tax law, di ba? It's a very helpful stepping stone, kumbaga, for the practice. So I hope you find this morning's discussion insightful, even if info overload, di ba? Info overload on the field of tax, since hindi siya masyado actually nako-cover during our undergraduate discussions. So in case you have questions, in case you have concerns, feel free to reach out to JPIA or to the organizers or to us. No? So we'll be happy to assist or answer your queries. And yun, thank you very much again to our team, to SGB team, and to our JPIA, to the CM team. And looking forward to the next two sessions. So good luck, especially to the upcoming finals, no, and the exams. And thank you and have a safe weekend.
All right, thank you so much for giving that motivational message as we close the space. Now, Edsel, it has really been a morning of helping students to stay updated with the country's new tax policies in response to our changing environment. Now, to officially close this event, let us all sing UP Naming Mahal. All right, that is the end of our first ever UPV Tax Lecture Series. So, as we finally close the space, please do not forget to accomplish the feedback form until 11:59 p.m. today in order to receive your blank yet signed certificates via email. You can now find the link in the Zoom chat that was sent by our Vice President for audit. On behalf of the University of the Philippines Visayas Junior Philippine Institute of Accountants and all our partner organizations, we would like to extend our sincerest gratitude to Sir Aaron and the entire SGV and Co team and all the attendees in the Zoom application for making all these possible. We hope to see you again in February at our next external event. This has been Nina Vanasio Saldo, UPV JPS Director for Non-Academic Affairs. Thank you, everyone, and have a good day. Happy holidays, everybody.
Wait a minute, this love started off so tender.